Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive in. Today, we're going to break down the core ideas from Pat Dorsey's classic, The 5 Rules for Successful Stock Investing. What we're doing here is pulling out the absolute essentials, the principles that really separate smart, long-term investors from people who are just, well, gambling. So if you're ready to build a real, solid framework for investing, you're in the right place.
This one sentence, it's pretty much the heart of the entire book. See, the actual rules for winning in investing, they aren't some kind of crazy, complex math formula. They're actually pretty simple. The hard part, the not easy part, is having the guts and the patience to actually follow them, especially when the market is going haywire and every bone in your body is telling you to panic.
So what do you think? Is it just a giant casino where you place your bets and hope for the best? Or is it a genuine path to building real, long-term wealth? Well, the book argues that the answer is, it's whatever you make it. The only thing that separates gambling from investing is your approach. And that's exactly what we're going to build today. Okay, so here's our game plan. We'll start with that core mindset. Then, we'll get into the 5 big rules for success. After that, we'll cover the 7 mistakes you have to avoid. We're also going to do a deep dive on this idea of an economic moat. And finally, we'll wrap it all up by talking about how you can build your own investing philosophy.
First things first, before we can even get into the rules, we have to lay the right groundwork. And that starts with knocking down a really common and frankly dangerous myth about what the stock market even is.
Back in the tech boom of the 90s, this idea took hold that the stock market was this magical machine that just spit out 15% returns year after year, no problem. A lot of people learned the hard way that's just not true. Real investing takes work. It takes discipline. It is absolutely not a get-rich-quick scheme. This right here, this might be the most important mindset shift you can possibly make. When you buy a stock, you're not just buying a little ticker symbol that bounces around on a screen. You are buying a small piece of a real, living, breathing business. And once you start thinking that way, everything changes. It forces you to focus on the things that actually matter, like how much cash the business generates and how strong it is against competitors, instead of the random, chaotic noise of the daily stock price. Okay, with that foundation in place, let's get to the good stuff, the core of the book. We're about to build the framework that can guide every single investment decision you make from here on out. These are the 5 essential rules. So here they are, all in one spot. Do your homework. Find companies with economic moats. Make sure you have a margin of safety. Hold on for the long haul. And know when it's time to sell. These aren't just 5 separate ideas. They work together like a system. So, let's break each one down. Rule number 1. Do your homework. I know, it sounds so obvious, right? But you'd be shocked how many people skip this step. I mean, think about it. You wouldn't buy a house without getting it inspected, would you? So why on earth would you buy a piece of a business without understanding it? This means you've got to read the reports, get to know the industry, and at least understand the basics of how to tell if it's making real money. And that leads us to this really cool idea, the economic moat. Just picture a castle with a giant moat around it protecting it from invaders. Well, in business, an economic moat is some kind of durable competitive advantage that protects a company's profits from all the competitors trying to attack it. It's the secret sauce that separates the truly great, long-lasting companies from the one-hit wonders. And we are definitely going to dig deeper into this one in a bit. Okay, this is so important. A great company is not automatically a great investment. Take Cisco back in 2000. It was an amazing company, but it was a terrible investment because the stock price was just insane. A great investment is when you buy a wonderful business at a fair, or even better, a cheap price. That little gap between what you pay and what it's really worth, that's your margin of safety. And it's not just a buffer for your money, it's a buffer for your sanity, because it gives you the confidence to stick around when things get rocky. Rule 4 is all about playing the long game, and this little story just says it all. So let me introduce you to long-term Lucy and trader Tim. Lucy puts her 10 grand in and just holds on. Tim, on the other hand, tries to be clever, jumping in and out of the market, which means he's paying a ton in short-term taxes. Fast forward 30 years and look what happens. Lucy's patience pays off, big time. Her account is more than double Tim's, and that's before we even talk about trading costs. But wait, it gets worse, a lot worse. Now let's factor in the fees Tim paid for all that buying and selling. It absolutely destroys his returns. I mean, look at that difference. He ends up with less than a third of what Lucy has. The message here couldn't be clearer.
Trying to be a short-term trader is a loser's game. The taxes and the fees just eat you alive. Patience isn't just a virtue, it's profitable.
And last but not least, Rule 5, selling with discipline. Your decision to sell should never, ever be because of some scary headline or because the stock dropped 10%. You sell for clear, business-related reasons. Reason 1, you messed up. Your original research was just plain wrong. Reason 2, the business itself has gotten worse, like fundamentally worse. Or reason 3, the stock has gotten so popular that its price is now completely ridiculous. That's it. Sell with your brain, not your gut.
Okay, so we've got the rules for what to do. But just as important, maybe even more important, is knowing what not to do. Just avoiding the big, dumb mistakes can be one of the most profitable things you ever do. So let's run through the 7 most common traps that investors fall into.
Let's walk through these, because they're huge. Number 1, swinging for the fences. Always chasing that lottery ticket stock instead of just hitting consistent singles and doubles. 2, getting caught up in hype and believing those 4 most expensive words in investing. It's different this time. 3, falling in love with a cool phone or a neat car without ever checking to see if the company making it actually turns a profit. 4, the big one, panicking and selling everything when the market tanks. 5, thinking you're smart enough to time the market. You're not. Nobody is. 6, ignoring valuation, just paying any price for a hot stock. And 7, only looking at the official earnings number without checking the actual cash flow. Avoiding these is half the battle.
You know, this quote from the legend Sir John Templeton, it's the perfect medicine for that number 4 mistake, panicking. What he's saying is that the best opportunities don't show up when everyone's happy and optimistic. They show up when there's blood in the streets, when everyone else is terrified and selling. A smart investor knows that widespread fear isn't a signal to run away, it's a signal to start looking for bargains.
Okay, remember I promised we'd circle back to this? Let's do that deep dive on what I think is one of the most powerful concepts in this whole book, the economic moat. This idea is the absolute key to finding those truly exceptional companies that can stand the test of time.
The medieval castle analogy is just perfect. A wide moat protected a castle from being attacked. In the same way, an economic moat protects a company's profits from the constant attack of competitors. It's a structural advantage. It could be a super powerful brand, a crucial patent, the network effect where more users make it better, or just being the lowest cost producer. Whatever it is, it's what allows a company to rake in high profits for years and years.
So, that's the million-dollar question, isn't it? It's one thing to know what a moat is, but how in the world do you actually spot one out in the wild? Well, luckily, the book gives us a pretty clear roadmap for how to analyze a company for one.
Here's the 4-step framework. It's actually pretty straightforward. First, you look at the company's track record. Has it been consistently profitable in the past? That's your first clue. Second, you have to pinpoint the source of the moat. Give it a name. Is it their brand, their technology, their scale? Third, you have to figure out how durable that moat is. Is it getting wider over time or is it getting filled in? And finally, you have to look at the industry itself. Some industries are just shark-infested waters where it's almost impossible to build a lasting moat. Okay, we've covered a ton of ground. We've talked about the right mindset, the 5 rules, the 7 deadly sins of investing, and that all-important idea of economic modes. Now it's time to bring it all home. Because the goal isn't to just memorize these rules, it's to weave them into your own personal, coherent investment philosophy. So think of this as your final checklist, the big takeaways from everything we've talked about. Number 1, have a solid philosophy and actually stick with it. 2, understand the business before you even think about buying. 3, hunt for those amazing companies with wide, deep economic moats. 4, be patient and disciplined, and always demand a margin of safety on the price you pay. And finally, 5, just hold on and let the incredible, magical power of compounding do its thing. And that really brings us to the final and most important question. And this one's for you. We've laid out the framework, the tools, and the core principles from a truly fantastic guide to investing. The knowledge is right here. But the next step, well, that's turning that knowledge into action. So the real question is, how are you going to use these rules to build your own philosophy for success? So what if I told you that there's a simple, timeless framework that can help you navigate the absolute chaos of the stock market? You know, it's pretty wild how few investors can actually explain their own investment philosophy. But without one, you're basically sailing without a rudder. Okay, let me tell you a quick story to kick things off. At one of the big Berkshire Hathaway annual meetings, somebody complained that Warren Buffett just, quote, says the same thing every year. But you know what? That's the whole point.
The real secret to success over the long haul isn't finding some new, flashy trick every year. It's about building a rock-solid philosophy and having the discipline to stick with it, even when it feels boring.
And honestly, this is the biggest trap for most people. Without that anchor, you just get tossed around by whatever's popular at the moment. Maybe you jumped on a meme stock because everyone on the internet was screaming about it, only to watch it completely crater. You get frustrated, you get emotional, and you end up making decisions that almost always end up costing you real money.
So to help you build that framework, here's our game plan. We're going to walk through a clear 6-part guide. We'll start with why you even need a philosophy. Then we'll cover the homework you have to do and this idea of economic moats. After that, we'll get into the margin of safety, see why patience is your superpower, figure out the right time to sell, and then wrap it all up with a simple checklist you can use.
Okay, let's jump right into that first point on our agenda, your investor's philosophy. Seriously, this is the absolute core idea. It's the foundation that's going to guide every single decision you make from this point forward. I want you to think of your philosophy as your anchor in a storm. The market is just constantly throwing waves of crazy news, loud opinions, and a whole lot of fear right at you. This philosophy is what keeps you grounded. It's what lets you stay patient, tune out all that noise, and stick to your plan, which, by the way, is exactly where most investors get into some serious trouble. All right, so now we get why a philosophy is so critical. Let's start building it with our first 2 practical rules. This is all about the essential groundwork, the stuff you absolutely must do before you ever even think about clicking the buy button.
Rule number 1 sounds so obvious, but you would be shocked how many people skip it. You have got to do your homework. This means really digging in and investigating a business. You got to read the annual report, especially the part where management talks about the business. You need to check out the competition. And yeah, you need a basic grasp of accounting. I'm not saying you need to be a CPA, but you should be able to look at a balance sheet and an income statement and know what story they're telling you.
So once you've done that initial research, it naturally leads you to this really important question. See, you're going to find a lot of good companies out there. But if you want to find those truly superior, long-term investments, you've got to be able to spot the great ones. So, what's the difference?
The answer is something called an economic moat. Think of a company like a castle. Its economic moat is whatever protects it from being attacked by competitors. For a company like Coca-Cola, that moat is its brand. It's just massive. For Google, it's the network effect of its search engine. These are powerful, sustainable advantages that protect a company's profits for years and years. Because in a normal economy, big profits are like a magnet for competition. A strong moat keeps those competitors at bay.
Now, finding a great company with a huge moat, well, that's only half the battle. You could find the most amazing, impenetrable castle in the world, but if you pay way too much for it, you're still not going to have a good investment. And that brings us to rule number 3, which is all about the price you pay.
This is such a critical point. I mean, just look at Coca-Cola back in the late 1990s. No question it was a fantastic company, with one of the biggest moats on the planet. But investors got so excited that they were willing to pay 50 times its earnings for the stock. And guess what? They had a really tough time making any money for a long time. The quality of the business couldn't save them from the crazy high price they paid.
So, to avoid that trap, you need what's called a margin of safety. Here's how it works. Let's say you do all your homework on a company and you figure out it's probably worth about $100 a share. That's its intrinsic value. Now, you know you could be wrong, so you apply, say, a 30% margin of safety. That means you will only buy that stock if it's trading at $70 or less. It's a buffer. It's a cushion that protects you if you are a little too optimistic or if something unexpected happens.
Okay, so we've done our research, we've set our price. Now let's dive into rule number 4. This one tackles one of the biggest, quietest wealth destroyers out there for investors, impatience. The crucial thing to get here is that trying to be a short-term trader is almost always a loser's game. And why is that? It's simple. The costs of trading all the time, we're talking taxes on your gains and commissions to your broker, they add up ridiculously fast. They create this massive headwind that you're constantly fighting against. Let's look at just how big that headwind really is.
So to really see the impact, let's compare 2 investors. Over on the left, you've got long-term Lucy. She buys a few good stocks and just hangs on to them. On the right, we have Trader Tim. He sells pretty much as soon as he makes a small profit. Now, for this example, they both start with $10,000, and they're both good enough to earn the exact same 9% return every year, before we factor in any costs.
And the results are, well, they're just staggering. Just look at this.
After 30 years, Lucy, who just held on and let her money compound, she ends up with over $114,000. Tim, on the other hand, who is constantly buying and selling, is left with just $54,000. That is less than half of Lucy's result, all because he let taxes eat away at his returns year after year.
But wait, it actually gets so much worse for Tim. When we factor in just a modest $15 commission on each trade, his portfolio gets absolutely decimated. He's left with just over $30,000. Meanwhile, Lucy, who maybe trades once every few years, she's barely affected at all. She still has over $92,000. The difference is just, it's mind-boggling.
Let's put a hard number on this. In our example, for trader Tim to end up with the same amount of money as long-term Lucy, he would need to be a 5% better investor every single year just to break even from all his extra costs. That is an enormous gap to overcome. Patience really pays.
Okay, so holding for the long term is obviously a huge key, but that doesn't mean you just buy something and forget about it forever. You also need a logical exit plan. And that brings us to our fifth and final rule, knowing when to sell.
First things first, let's be super clear about what not to do. Selling a stock just because the price went down is a mistake. And you know what? Selling it just because the price skyrocketed is also pretty bad logic. The stock market does not care one bit what price you paid for something. Your decision should always be based on the business itself, not the squiggly lines on a price chart.
Instead, your decision to sell has to be a deliberate, logical process. And this checklist here is a really powerful way to guide your thinking. Before you even think about hitting that sell button, ask yourself these questions. Was I just plain wrong when I first bought this? Have the company's fundamentals, its moat, its profits, started to crumble? Has the stock price gone absolutely nuts, way beyond any reasonable value? Is there a much better place I could put this money right now? Or has this one stock just grown to be too big a piece of my portfolio, creating too much risk?
So we have walked through the 5 foundational rules for building a solid, disciplined investment philosophy. Let's pull them all together into one final, actionable checklist that you can actually use.
And here it is. This is your 5-rule framework. Number 1, do your homework. Number 2, find those economic moats. Number 3, always insist on a margin of safety so you don't overpay. Number 4, hold for the long haul and let compounding do its thing. And number 5, have a logical reason for when you sell. You see, this isn't about timing the market or chasing hot tips. It's a philosophy, and it's built on discipline, on research, and on patience.
You know, the biggest takeaway from all of this is that successful investing isn't really about outsmarting the market. It's about mastering your own emotions and sticking to a disciplined process. So, as you look at this framework, I want you to think about your own approach. What's the first thing you're going to challenge about how you invest now? What's the very first step you'll take to build your own personal investment philosophy?
Hey, welcome. So we're going to talk about a really powerful idea today. What if winning at investing isn't about making brilliant moves, but about not making dumb ones? It's really more about playing great defense, about learning to avoid these simple, common errors that trip up so many people along the way.
You know, it's a lot like amateur tennis. Seriously. You don't need a killer serve to win your local tournament. You just need to be the person who consistently, patiently gets the ball back over the net. In investing, it's the same thing. Avoiding those big blunders is what keeps you in the game long enough to actually win it. I mean, think about it. It takes a whole lot of great stock picks to make up for just 1 or 2 really big mistakes.
All right, so let's get into it. Here are the 7 big unforced errors we're going to break down. First, we'll hit the big idea traps. These are the really seductive stories that can get you into trouble. Then, we'll get into the psychological traps. You know, the ones our own emotions lay for us. And finally, we'll look at how easily deceptive numbers can lead you down the wrong path.
So this first group of mistakes, the big idea traps, they're all about getting seduced by a really compelling story. This is where we see people swinging for the fences, believing it's different this time, or falling in love with a great product instead of a great business. These are really just traps of imagination and, frankly, overconfidence.
And that kicks us off with mistake number 1, swinging for the fences. Oh man, this one's a classic. It's that temptation to just load up your portfolio with these super risky, all-or-nothing stocks, just hoping you hit that one massive home run that makes you rich overnight. It feels exciting, for sure, but the math behind it, it's absolutely brutal. And yeah, this is what some people call the insidious math of investing. Just let that sink in for a second. If your stock gets cut in half, a 50% drop, you don't need a 50% gain to get your money back.
No, you need a 100% gain. It has to double just to get back to where you started. That is a massive mountain to climb, and it's exactly why avoiding those huge losses is so critical for your long-term success. But of course, this is the question that drives that whole swing for the fences mentality, right? Everybody wants to find the next big thing, to get in on the ground floor of a company that's going to change the world. But what does the actual long-term data say about chasing those kinds of high flyers? Well, the answer might surprise you. So check this out. This slide pretty much turns conventional wisdom on its head. When you look at data all the way back to 1927, small growth stocks, the very category where you'd be hunting for the next big thing, have actually been the worst performing type of stock. They've returned about 9.3% a year, while the plain old boring S&P 500 returned 10.7%. Now, that might not sound like a huge difference, but over decades of compounding, that's an enormous gap in your wealth.
Okay, let's move on to mistake number 2, which is believing this one simple phrase. There's this famous saying on Wall Street, and it is just so true. The 4 most expensive words you'll ever hear are, "It's different this time." It's such a powerful warning because history really does tend to rhyme, especially when it comes to markets and human behavior.
And look, this shows you exactly how that plays out in the real world. Back in 2000, at the peak of the tech bubble, the story was that chip stocks had entered this new paradigm, that the old economic cycles were dead. Well, they weren't. Then a year later, the story was all about endless growth in energy. That didn't pan out either. So whenever you hear someone arguing that the old rules don't apply anymore, your skeptical alarm should be going off, big time.
And this brings us right to mistake number 3, falling for a great product, not a great business. This is probably one of the easiest traps to fall into because it just feels so logical. You find a product you love, you see everybody using it, and you think, wow, this company must be an amazing investment. But here's the thing, a great product and a great business can be 2 completely different things.
The Palm Pilot is just the perfect and honestly painful case study here. I mean, it was a revolutionary device. Millions of people, myself included, absolutely loved it. But the business behind it? It was getting crushed in a brutal, low-margin industry. The economics were terrible. And so, despite how popular the product was, the company's stock was a total disaster for investors. It lost over 98% of its value. So you always have to ask yourself, is this an attractive business? Not just, is this an attractive product?
Okay, so the next couple of mistakes we're going to talk about aren't really about bad ideas. They're driven by our own internal wiring. We're talking about panicking when the market goes down and trying to perfectly time the market. These are the classic unforced errors we make when we let fear or greed or just our own ego take over the controls.
This fantastic quote from the legendary investor Sir John Templeton is the perfect introduction to mistake number 4, panicking in a downturn. It's totally natural, right? Our gut instinct is to run for the hills with everybody else when things look grim. But in the world of investing, that is very often the exact wrong thing to do. The best opportunities, the real bargains, almost always show up when everyone else is absolutely terrified.
And this right here, this is maybe the most famous example of that in all of market history. In 1979, after a really rough decade for stocks, a major business magazine literally declared the death of equities on its cover. And that exact moment of maximum pessimism, it was, in reality, the absolute best time to buy, kicking off one of the greatest bull markets ever.
Okay, this leads us to mistake number 5, trying to time the market. So if panicking is about letting fear drive you out of the market, this mistake is about letting your ego convince you that you are smart enough to perfectly jump in and out at just the right moments. It's one of the great seductive myths of investing. But the simple truth is nobody, and I mean nobody, can do it successfully and consistently.
And look, we've got the data to prove it. There was this fascinating study that analyzed every possible monthly switch you could make between stocks and cash, all the way from 1926 to 1999. And the result? A simple buy and hold strategy beat 2/3 of all of those market timing strategies. The odds of you winning this game by jumping in and out are just not on your side.
And even that 33% chance of success is really just an illusion. And here's why. First, timing strategies completely break the magic of compounding. Even worse, the market's biggest gains are often packed into just a tiny handful of explosive days. If you happen to be on the sidelines for those few days, your long-term returns can get totally crushed. And the proof is in the pudding. Out of thousands of professional mutual funds, not a single one has ever shown a verifiable, repeatable ability to time the market. All right, so for our final category of mistakes, we're moving away from psychology and into the world of flawed analysis. This is where we'll cover the last two errors on our list, ignoring valuation and relying only on reported earnings. These are the kinds of errors that happen when we look at the wrong numbers or when we completely misinterpret the right ones.
So that brings us to mistake number 6, ignoring valuation. This often shows up as playing this really dangerous game called the greater fool theory. The idea is that you buy an overpriced stock simply because you believe some greater fool will come along and pay an even higher price for it later. But let's be clear, that's not investing. That is pure speculation, and it's a game that almost always ends badly.
So your best defense against this kind of risk is understanding a concept called intrinsic value. It just means you stop trying to be a stock chart psychic and you start being a business analyst. You focus on what a company is fundamentally worth based on its assets and its future earning power. You ask yourself, if I had the cash, would I buy this entire company for this price? Paying a fair price for a good business, that's how you build a crucial margin of safety into your portfolio.
And finally, mistake number 7, relying only on reported earnings. Please don't be fooled by the big headline number everyone talks about, earnings per share or EPS. Because of all sorts of accounting rules and choices, earnings can often be managed or, manipulated to tell whatever story the management wants to tell. The true, unvarnished health of a business, that's revealed in its cash flow, the actual cash coming in and going out. It is much, much harder to fake cash.
Okay, so let's wrap this all up. We've just walked through the 7 most common and most costly unforced errors in investing. And seriously, if you can just keep this checklist in your mind, you will be miles and miles ahead of the average investor and well on your way to playing a winning game. So here it is, your game plan. It's all about focusing on solid companies at low valuations, not chasing some speculative story. It means you ignore anyone who says it's different this time, and you always check the business model, not just the cool product. You learn to use market fear to your advantage, and you accept that the market just can't be timed. And finally, you pay careful attention to valuation to manage your risk, and you remember that cash flow is the true measure of performance. This is your guide right here to avoiding those costly mistakes.
So, as we wrap up, I just want to leave you with this final thought. Winning the investing match. It's not about hitting the perfect shot every single time. It's about knowing which foolish shots you shouldn't even take. So, take an honest look at your own approach. Which one of these unforced errors could you eliminate from your game, starting today?
Have you ever wondered why some companies, like a Coca-Cola, seem to dominate for a century, while others are these blazing superstars one year and then poof, they're gone the next? Well, it's not just luck. There's this powerful protective force that separates the true legends from the temporary leaders. And today, we're going to pull back the curtain on exactly what that is, the economic moat. This quote right here, it gets to the very heart of the problem for any successful company. The simple truth of a free market is that massive profits act like a giant magnet for competition. The more successful a company gets, the more everybody else wants a slice of that pie. And it's this constant, relentless pressure that explains why past success is absolutely no guarantee of future greatness.
So, to really get our heads around this, here's the game plan. We're going to start with that core problem, what we're calling the profitability paradox. Then we'll nail down exactly what an economic moat is, show you how to spot one in the actual numbers, and then we'll dive into the 5 main ways companies build these things. We'll also ask how long they last, and we'll wrap it all up with a super practical checklist for you. Okay, so let's dig into this paradox. It's simple, really. Capital always chases the highest return. Just think about it. When a company like Pfizer is raking in huge profits from a new drug, you can bet there are armies of lawyers at generic drug companies working 24/7 to figure out how to copy it. Or remember the late 90s? Cisco was growing like crazy, and it felt like venture capitalists were just throwing money at any networking startup that could possibly challenge them. If a company looks like a gold mine, you can be sure other people are going to show up with shovels.
So, how does a company actually defend itself from all that? The answer is an economic moat. The idea, which was made famous by the legendary investor Warren Buffett, is actually pretty simple. I want you to picture the company as a castle, and its profits are the treasure locked inside. Well, the economic moat is that durable competitive advantage, that deep, wide ditch filled with crocodiles that keeps all the competitors out. It's the structural feature that lets a company fight off attacks and keep making high profits for a long, long time.
Right, so to figure out if a company has a real moat, we can't just guess. We need a system, a framework.
And this is a fantastic one. It all starts by asking 4 key questions. First, is the company actually profitable? And has it been for a while? Second, if it is, why? What's the real source of that advantage? Third, how long can that advantage possibly last? And fourth, how tough is the neighborhood, the industry that it's playing in? Let's tackle step 1, looking for the financial evidence. Because before we get into all the cool strategies and stories, we need to see cold, hard proof. A real economic moat isn't just a good idea. It leaves very clear, undeniable tracks all over a company's financial reports. A fantastic place to start looking is free cash flow. In plain English, this is the cash a company has left over after paying for everything it needs to maintain and grow its business. It's the money that, in theory, you could just take out of the business every year without hurting it one bit. And when we look at it as a percentage of sales, we're really seeing how good a company is at turning its revenue into pure spendable cash. And here's a great little benchmark for you. If a company can consistently turn more than 5% of its sales into free cash flow, you've probably found a true cash machine. Now, that sounds simple, but it is way tougher than it looks. Only about half of all the companies in the S&P 500 can clear that bar. So it's a really strong first sign of a potential moat. Okay, next up, we've got return on equity, or ROE. This number tells you if the people running the show are actually creating value for the owners, that's the shareholders. It asks a really simple question. For every single dollar that shareholders have put into this company, how much profit is it kicking back out? It's a super direct measure of how well management is using investors' money. And again, we've got a handy rule of thumb. A company that consistently posts an ROE above 15% is doing a fantastic job for its owners. I mean, an ROE that high, year in and year out, strongly suggests there's some kind of protective moat at work, letting that company earn profits way above what you'd consider average for the market. So, and this is probably the most important point about the numbers, consistency is everything. With all these metrics, a single good year means almost nothing. A fluke, maybe. A real economic moat is all about durability. You've got to see this kind of strong performance sustained over a long, long time. We're talking at least 5 years of data, and honestly, 10 is even better. It's the ability to keep those competitors away for years that creates real, lasting value. All right, so we've seen what the financial evidence of a moat looks like. But why do those great numbers even exist? Now we need to play detective and identify the source of the moat itself. What is the company actually doing to keep its competitors from eating its lunch? Well, generally speaking, companies build these defenses in one of 5 main ways. They can have a genuinely better product because of their tech, a perceived better product thanks to a powerful brand. They can simply be the low-cost producer, they can lock in their customers with high switching costs, or they can find ways to lock out their competitors entirely. Let's break each of these down. First up, differentiation. On one side, you have real differentiation, usually from technology. Back in the 90s, the data storage company EMC had a product that was just light years ahead of IBM, and they made a fortune. But the problem is, tech advantages are often fleeting as competitors race to catch up. On the other side, you have perceived differentiation, which is all about brand. A diamond ring from Tiffany & Co. might be physically identical to one from the jeweler down the street, but people are willing to pay a huge premium for that little blue box. This is a perfect example of how a strong brand can be way more durable than a temporary tech lead. Another incredibly powerful moat is just being the low-cost producer. And this usually comes from one of 2 places. It can be a process advantage, like Dell's revolutionary build-to-order model back in the day. It completely slashed their inventory costs and let them undercut everybody else. Or it can be a scale advantage. Think of Intel. Because they make so many more computer chips than their rivals, the massive cost of building a new factory gets spread over way more chips. This gives them a lower cost for each chip that is almost impossible for smaller guys to match. Now, this next moat is a bit more subtle, but it's one of the most powerful out there, creating high switching costs for your customers. And the key thing you've got to realize here is that it's rarely just about the money. Most of the time, the biggest barrier to switching is the time and the hassle involved. You know, learning a whole new system, retraining your entire staff, changing a critical process. That's where the real pain is. So, how do you spot high switching costs in the wild? Well, you can ask yourself these kinds of questions. Does the product require a lot of training? A perfect example is a medical device firm like Stryker. A surgeon might spend a ton of time learning to use a specific artificial hip implant. They are not going to switch to a competitor's product just for small discount, because the cost of retraining in time and effort is absolutely massive. Is it deeply integrated into their business? Is it an industry standard? Or maybe the benefit of switching is just so small compared to the headache of doing it, like, changing your bank. And the last source of a moat is basically locking out your competitors. This can be done through legal, regulatory means, like Pfizer's patents, which give them a legal monopoly on a drug for a number of years. But an even more durable way to do this is with something called the network effect. This is a really beautiful concept where the product or service actually gets more valuable as more people use it. And eBay is the classic example here. Sellers want to go where the most buyers are, and buyers want to go where the most sellers are. It creates this amazing virtuous cycle that becomes nearly impossible for a new competitor to break into. So we've identified the sources of these moats, but that's not quite enough. We also have to ask a really critical question. How long is this thing going to last? See, a moat really has two dimensions. Its depth, which tells you how profitable the company is, and its width, which tells you how long it can keep those profits going. A hot tech company might have a very deep but narrow moat, huge profits for just a year or two. A brand like WD-40, on the other hand, has a pretty shallow but incredibly wide moat, modest profits that have lasted for decades. This table gives some fantastic examples to really make this concept stick. A wide moat company like eBay has that powerful network effect we talked about, which creates a near monopoly. Dell's super lean operating model gives it a wide moat as a low-cost producer. Now, in the narrow moat category, you've got a company like Disney. Yes, it has incredibly valuable brands, but it's facing way more competition these days. Or Target, whose cheap chic thing is effective but also really risky because it depends on guessing fashion trends correctly. And then you have companies with basically no moat, like General Motors, stuck in a brutal cyclical industry, or Staples, where there's just intense price competition and very little that makes one store different from the next. Okay, we have covered a ton of ground, so let's pull all of this together into a final actionable checklist. Here are the absolutely crucial points to take away. First, never forget that high profits are a magnet for competition. A moat is the only real defense. Second, look for the proof. Consistent high returns on capital are your evidence. Third, you've got to identify the source. Is it low cost, a great brand, or high switching costs? Fourth, always think about both dimensions: depth, how much profit, and width, for how long. And finally, don't forget to analyze the entire industry, because let's be honest, some industries are just way easier places to build a castle than others. And that brings us to our final thought. This framework isn't just for some analyst on Wall Street. I want you to look around at the products and the services you use every single day. The phone in your pocket, the coffee you drink, the software you use at work. Which of those companies do you think have a real, durable economic moat? And more importantly, can you figure out why? All right, welcome to the Explainer. So have you ever opened up a company's annual report and just your eyes glaze over? It feels like you're trying to read a different language, right? Well, guess what? It is a language. And today, we're going to learn the 3 most important sentences in that language. The 3 core financial statements that tell you everything you really need to know. So here's what we've got on tap. We'll start by thinking of these statements as windows into a company. Then, we'll follow the money to see how it all connects. We're going to build a simple business, Mike's hot dog stand, to see it all in action. And we'll finish up with the big one: why profit is not the same as cash, and what that means for you as an investor. Okay, let's dive right in. Now, I want you to forget about spreadsheets and numbers for just a second. Instead, picture a big, impressive building. You can't really know what's going on inside just by staring at the front door, can you? Nope. You need to look through different windows. And that's exactly what financial statements are. They're 3 totally unique windows, and each one gives you a different, essential view of a company's business. And here they are, our 3 main windows: the balance sheet, the income statement, and the statement of cash flows. You'll see these for any public company, period. And there's a good reason for that. Each one answers a completely different and fundamental question about the business. Trust me on this, if you only look at one, you are absolutely going to miss the real story. So let's start with the first window, the balance sheet. You know how you take a photo? It captures a single moment in time. That's a balance sheet. It's a financial snapshot taken on a specific day, say the last day of the year. And it answers a simple question. What does the company own? Those are its assets. Versus what does it owe? Those are its liabilities. It's all about financial health at one specific point in time.
Okay, so if the balance sheet is a snapshot, what's our next window? Well, the income statement, that's the movie. It's not about one moment in time, it's about the story over a whole period, like 3 months or an entire year. It starts with the top line, all the sales coming in. Then you subtract all the costs and expenses. And at the very end, you get the bottom line, the big reveal. Did they make money or did they lose it? And that brings us to our third window, the statement of cash flows. Now listen up, because this might just be the most important one. Why? Because it's the ultimate reality check. You see, a company's income statement, its movie, can look like a blockbuster. We're talking huge sales, big profits. But what if none of that was actual cash? What if it was all promises to pay? The cash flow statement cuts through all the noise and shows you what really happened with the hard cash. Where did it come from and where did it go? It doesn't lie.
Okay, so we've got these 3 different views, but how do they all fit together? Well, it all boils down to following the money. Let's actually trace the path of a dollar as it moves through a company from beginning to end.
This chart right here, this is basically the lifeblood of any business. It all starts with investors putting capital in. The company takes that cash and buys stuff, assets, to make a product or service. That product, the inventory, gets sold. Now, hopefully that sale brings in cash, and that cash is the fuel for the whole engine. It gets used to pay the bills, pay taxes, grow the business, and if things go well, to pay back the investors who started the whole thing. It's a beautiful cycle when it works. Okay, theory is great, but let's make this real. To see how all this works in practice, we're going to build a company from the ground up. So let's meet Mike. And his business? A classic, Mike's hot dog stand. We're going to watch every move he makes and see how it hits his books. All right, every business needs startup cash, right? So Mike goes to the best bank he knows, the First National Bank of Mom. He gets a $100 loan. And boom, just like that, with that one simple transaction, his balance sheet is born. And check this out. This is the golden rule of accounting. The books always have to balance. On one side, he's got an asset, $100 in cash. But on the other side, he's got a $100 liability, the loan he owes his mom. See? 100 equals 100. Perfectly balanced, as all things should be. So, what's he do with the cash? He can't sell cash. He puts it to work. He buys a hot dog stand and some hot dogs. Now, this is a really important point. He hasn't spent the money in the sense that it's gone. He's just swapped one kind of asset, cash, for other kinds of assets that can actually make him money. So you can see his cash went down by $90. But look, that value just moved. $20 of it is now inventory, the hot dogs. The other $70 is in what fancy accountants call property, plant, and equipment, or PP&E. That's his stand. And what's the total value of all his assets? You guessed it, still $100. The balance sheet is still balanced. All right, stand is set up, hot dogs are ready, Mike is officially open for business. Now the fun really begins. From here on out, every single sale, every single expense is going to start telling a story on his financial statements. And right out of the gate, we get a super important situation. He sells $30 worth of hot dogs, awesome, but he only gets $23 in cold hard cash. His buddies bought $7 worth, but said, hey, I'll pay you back later. This creates something called accounts receivable. It's basically just a fancy term for an IOU from your customers. Now this is where you gotta pay attention, because this is where people get tripped up. His income statement will say he made $30 in sales, but his cash only went up by $23. That other $7, it's not cash yet. It's sitting in that accounts receivable asset. And of course, the hot dogs he sold are gone, so his inventory asset goes down. Of course, credit is a two-way street. Just like people can owe Mike money, he can owe other people money. He's running out of buns, so he runs to the store and the grocer lets him take $5 worth on credit. This creates the opposite of accounts receivable. It's called accounts payable. This is his IOU to a supplier. So let's look at the impact here. His inventory goes up by $5. Great, he has more buns to sell. But did his cash go down? Nope, not a penny. Why? Because he bought on credit. So instead of cash going down, a new liability, that accounts payable, pops up on the other side of the balance sheet to keep it all square. Okay, one last thing for the day. His stand, his tongs, they got used, right? They're not in perfect condition anymore. This wear and tear is a real business cost, and it has a name. Depreciation. Now, here's the key thing to remember. It's an expense that shows up on the income statement, but no cash actually changed hands. Mike didn't pay anyone $1. And that little detail is going to be huge in just a minute. All right, we've done all the setup. Now we are at the single most important idea in this entire explainer. Seriously, this is the big aha moment.
If you get this next part, you will be miles ahead of most people because you'll understand why a company's profit is so often wildly different from its actual cash. So here's the central mystery we need to solve. According to his income statement, Mike's profit for the day was $19. But if you look at his wallet, his cash went up by $23. How? How is that even possible? What's going on? Well, the answer is found when we build a bridge from his profit to his cash. So first, here's the income statement. It's pretty straightforward, right? $30 in sales. We subtract the $10 it cost him for the hot dogs he sold. Then we subtract that $1 depreciation expense for the wear and tear on a stand. And there you have it, a net profit of $19. This is what we call his accounting profit. Okay, now for the magic. How do we get from a $19 profit to $23 in cash? We build a bridge. We start with the net profit of $19. First, add back that $1 for depreciation, because that was a non-cash expense. Then, we adjust for inventory. His inventory changed, and that change created $5 in cash flow, so we add that. Next, accounts receivable. He's still waiting on $7 from his friends. That was counted as revenue, but it's not cash, so we have to subtract it. But then look at accounts payable. He got $5 of buns on credit, meaning he held on to cash he otherwise would have spent. That's a good thing for cash flow, so we add that $5 back. So what's the math? 19 plus 1 plus 5 minus 7 plus 5 again. And what does that equal? $23. Exactly. That's his actual operating cash flow. Whew. Okay, I know that was a deep dive, but we've gone from the big picture right down to the nitty-gritty. So what does this all mean for you when you're looking at a real company? What are the big takeaways you need to stick in your brain? Here's the checklist. Keep this simple. The balance sheet, that's the snapshot of financial health. The income statement, that's the movie of its performance. The cash flow statement, that's the ultimate truth detector. Which brings us to the most important point of the entire day. Accrual accounting, which gives you profit, is a different beast from cash accounting. You have to look at both the income statement and the cash flow statement, always, no exceptions. That's how you get the real story.
So if you take away just one thing today, let it be this. Profit is an opinion, but cash is a fact. A smart accountant can make a profit look like anything, but they can't fake the cash in the bank. When you learn to read all three of these statements together, you stop being just a spectator looking at the final score. You become an analyst who understands how the game was actually played. You now speak the language of investing. So what story are you going to go uncover?
Welcome to The Explainer. Today, we're going to crack the code on how to really understand what's going on inside a company. Forget the slick ads, forget the mission statements. We are going straight to the source and decoding its financial DNA.
You know, if you really want a company's most honest story, you're not going to find it in a press release. It's definitely not in their flashy commercials. Nope. The real, unvarnished truth, it's told in 3 key documents. And once you learn how to read them, you can see pretty much everything.
So think of this whole thing as a financial health checkup. First, we're going to check the company's vital signs with the balance sheet. Then, we'll do a performance review with the income statement. And finally, we'll run the blood work with the cash flow statement to get the full, unadulterated diagnosis.
Okay, let's dive right in. Our first stop is the balance sheet. Now, the best way to think about this is like a high-resolution photograph. It's a snapshot of the company's financial position at one specific moment in time. It tells us exactly what it owns and exactly what it owes.
And you know what? The whole thing is built on one simple but really powerful equation that has to, always, balance. On one side, you have what the company owns, its assets. And that has to equal what it owes to lenders, its liabilities, plus what belongs to its owners, the shareholders. And that last part is the equity.
So here's the bottom line. Equity is what the shareholders actually own. It's their real stake in the company. If the business sold off every single thing it owned today and paid back all of its debts, this is the pile of cash that would be left for the investors. It's the true net worth.
Okay, now this is where it gets really interesting because you can start to spot red flags just by comparing a couple of numbers. Back in 2002, Hewlett-Packard's accounts receivable, that's just the money customers owed them, it shot up by a whopping 90%. But look at their sales. They only grew by 25%. That huge gap, that's a warning sign. It might mean HP was getting desperate to make sales, offering easy credit just to get stuff out the door, and taking on a big risk that they'd never actually get paid.
Now let's look at a completely different number, 92. This one isn't from HP, it's from their biggest rival at the time, Dell. And on its own, 92 doesn't sound like much, right? But trust me, this little number tells a story of almost unbelievable efficiency.
And here's what that 92 really means. It's Dell's inventory turnover. They sold through their entire stock of computer parts 92 times in a single year. That's insane. By comparison, HP only did it 6 times. See, Dell's cash wasn't just sitting around as parts on a shelf. It was constantly moving, constantly working, and in the fast-moving world of tech, that gave them a massive, massive competitive advantage.
Our source material has this fantastic warning, and it applies to a line item you'll sometimes see on the balance sheet called goodwill. This thing usually pops up after a company buys another one for way more than it's worth on paper. After HP bought Compaq, for instance, more than $15 billion of goodwill just appeared on its books. We're told to be skeptical because it's basically the company admitting it overpaid, and that value, it can vanish with the stroke of an accountant's pen.
All right, let's move on to the income statement. If the balance sheet was that single snapshot, the income statement is the movie. It shows you the company's financial performance over a whole period of time, usually a year. This is where we see the revenue, the costs, and of course, the profit.
And just by putting Dell and HP's income statements next to each other, you can immediately see their completely different game plans. I mean, sure, they both sold computers, but how they made their money, worlds apart. And the whole story is just laid bare right here in the numbers.
Let's just look at one line. Gross margin. That's the profit on each sale before you even pay for things like marketing or R&D. Dell's was a super lean 17.9%. That's their whole model, low cost, high volume. HP, on the other hand, had a much fatter margin, almost 25%, because they were selling pricey, specialized equipment to big companies, often with high-margin software thrown in. But here's another one of those red flags you need to watch out for. After buying Compaq, HP's income statement was just littered with these so-called non-recurring charges. In 2002 alone, they booked over $3 billion in costs for restructuring and the acquisition. They call them one-time costs, but are they really? And this is exactly why you have to be so skeptical of companies that become serial chargers. You know, if a business seems to have some massive, unforeseen, one-time expense popping up year after year, you have to start asking yourself, are these costs really a surprise? Or are they just the normal cost of doing business that management is trying to sweep under the rug? Okay, this brings us to what might be the most important statement of them all, the cash flow statement. This is the ultimate reality check. It cuts through all the accounting jargon, all the estimates and assumptions, and it just shows you where the actual physical cash came from and where it went. Our source calls it the touchstone for corporate value creation, and for a really good reason. You know, profits on an income statement, they can be fiddled with based on accounting rules. But cash, well, cash is cash. You can't fake it. This statement tells you exactly how much real cash a company is generating. And at the end of the day, that's what truly matters. And it's broken down into 3 pretty simple parts. First, you've got cash from the core business itself, from operations. Second is cash used for investing in things, like building factories or buying other companies. And third, cash from financing, so money from investors or lenders. Now, we are most interested in that first section, because it reveals the true cash-generating power of the business.
So let's take a look at Dell's statement. See how it starts with the net income number right from the income statement, which was $2.1 billion? Then it makes a whole series of adjustments to get from that official accounting profit to the actual real cash that wound up in the company's bank account.
And there it is. This is the holy grail. Dell's net cash provided by operating activities. The company reported $2.1 billion in profit, right? But it actually generated over $3.5 billion in cold, hard cash from its business that year. That is a sign of a very, very healthy, well-run operation.
All right, now for the grand finale. Let's put all 3 pieces of our puzzle together to get the full diagnosis. By connecting the stories from the balance sheet, the income statement, and the cash flow statement, we can finally get a complete picture of Dell versus HP.
This table just lays it all out so clearly. The story these statements told us is unmistakable. Dell was a hyper-efficient, low-margin machine with a clean income statement and very little risk on its balance sheet. HP, on the other hand, was a higher-margin company, sure, but it was also way more complex, carrying a big chunk of goodwill risk from its acquisition and a history of these massive one-time charges. And that right there is the key takeaway. These 3 documents are not just a boring collection of numbers for accountants, not at all. They work together to tell a complete, compelling story about a company's real health, its core strategy, and maybe most importantly, how well it's actually pulling that strategy off.
So we'll leave you with this question. We've looked at the vital signs, we've done the performance review, and we've run the reality check. Now that you know how to read the signs and decode the story for yourself, which company's story do you find more convincing?
Have you ever just stared at a stock chart, with a line going up and down, and wondered, what is really going on with that company? Well, today, we're going to pull back that curtain. We're going to tune out all that market noise and learn how to do a real health check on a business. Think of it like your financial detective, and we're about to crack our first case.
So that's the big question, isn't it? We're not just looking for a company that seems good on the surface. We want to know if it's genuinely healthy from the inside out. We're going to be like company doctors, performing a full diagnostic checkup to see what's really going on under the hood.
And here's our game plan for that checkup. First, we'll lay out a framework. Then, we'll check the company's vital signs by digging into its growth. After that, we'll measure the strength of its heart, its profitability. We'll assess the strength of its foundation with financial health, understand the risks, and then we'll wrap it all up with a practical investor's checklist you can use. Okay, let's get started. The framework we're going to use is a 5-point medical checkup, and it's designed to diagnose the true health of any business step by step. So our checkup covers 5 key areas. We're going to tackle the first 4 today: growth, profitability, financial health, and risks. We're going to save management for another day because, trust me, that is a huge topic all on its own. All right, first up, let's check the company's vital signs. We're talking about growth. Now, this is where a lot of investors get tripped up. I mean, super fast growth looks incredible on paper, right? But if you don't understand where that growth is coming from, you could be walking straight into a trap. You see, in the long run, sales growth is what drives everything else. And truly high-quality, sustainable growth really only comes from one of these 4 things. Is the company selling more stuff? Can they raise their prices without losing customers? Are they coming up with great new products? Or are they just buying up other companies? Knowing which of these levers they're pulling tells you a ton about the quality of that growth. And this right here is so important. This is the difference between a solid, mighty oak tree and, well, a house of cards. One is built to last for decades. The other is built to look impressive for a moment, right before it all comes crashing down. Let's look at a classic example. So let's jump in a time machine and go back to the 1990s and take a look at IBM. If you were an investor back then, you'd see this chart and think, I've struck gold. I mean, look at that earnings per share growth. Double digits, year after year after year. On paper, this looks like a perfectly healthy, thriving company. What's not to love? But this is where a good analyst, our good company doctor, has to ask the next question. Is this growth for real? Is it healthy? What's the real story hiding behind these fantastic numbers? And here's the big reveal. The top line, that's their amazing earnings soaring high. But look at the bottom line, the actual cash coming in from operations. It was totally flat, stagnant. The cash, the actual lifeblood of the business, wasn't growing at all. So how is that even possible? Well, IBM was pulling levers that don't last forever. They were cutting costs, but you can only cut so much. They were buying back their own stock, which makes the earnings per share number look better. And they got lucky with a one-time drop in their tax rate. None of that had to do with actually selling more stuff. This brings us to a really important concept called manufactured growth. Now, this isn't necessarily illegal or anything, but it is a huge, flashing red flag for an investor. Whenever you see earnings growing way faster than sales and cash flow over a long period of time, it's a sign that the growth probably isn't coming from the core business, and it probably isn't going to last. Okay, so let's move on to our next diagnostic test, measuring profitability. If growth is the vital sign, then profitability is the heart of the business. It's all about how efficiently a company can turn $1 of investment into more than $1 of profit. And a fantastic tool for this is something called return on assets, or ROA. The best way to think about ROA is that it has 2 engines. The first engine is net margin. That's basically how much profit you make on every single thing you sell. The second engine is asset turnover. That's the speed at which you sell all your stuff. A company can be profitable by having really high margins or by just selling a ton of stuff at a lower margin. When you multiply those 2 engines together, you get the company's total efficiency. It's ROA. And this is just a brilliant illustration of how powerful ROA is. Back in the day, Best Buy and Circuit City were huge competitors. Now, if you look at their net margins, that top line for each company, they weren't all that different, both floating around 2 to 3%. But now, look at that second line, asset turnover. Back in 2000, Circuit City's turnover was 3.2. Best Buy's was 4.5. That means Best Buy was working its assets, its stores, its inventory, a whopping 40% harder, squeezing way more sales out of everything it owned. That superior efficiency is what made it a much, much healthier business. Now, we can build on that idea with something called return on equity, or ROE. This takes our ROA and it multiplies it by a new factor, financial leverage. And that's just a fancy way of saying how much debt the company is using. So ROE is driven by 3 levers: your margins, your turnover speed, and your debt. But you have to be really careful because that third lever, debt, that can be a real double-edged sword. So what's a good number to look for here? Well, as a general rule of thumb, if a non-financial company can consistently generate an ROE above 10% and do it without taking on a mountain of debt, you're probably looking at a really high-quality business. It is a very tough bar to clear year after year.
Okay, get ready for this next one, because this slide shows one of the most powerful diagnostic tools an investor can have. It's called the profitability matrix. It helps us classify companies by mapping their ROE against their free cash flow. This gives you an amazing snapshot of a company's personality and its risk profile. Basically, it splits the whole universe of companies into 4 basic types. So, up in the top right quadrant, you have what's called the sweet spot. These are your proven winners. Think of a company like Pfizer. They've got a high ROE, so they're great at earning returns, and they generate tons of extra cash. These are mature, lower-risk, money-making machines. Then below them, in the bottom right, you have the reinvestors, like Lowe's. They're also super profitable with a high ROE, but they don't generate much free cash because they are pouring every single dollar they make right back into the business to grow as fast as possible. Now, over on the left side of the map, things start to get a little bit riskier. In the top left are the question marks. They are generating cash, which is a good thing, but they haven't yet proven that they can actually invest that cash and earn a high return on it. And then in the bottom left, you find the speculators. Think of a young Amazon. They have a low ROE and they're just burning through cash, making a huge bet that all this investment today will lead to massive profits way down the road. This is definitely the highest risk quadrant on the map. Okay, time for our 4th checkup point, financial health. You see, a company can have fantastic growth and look really profitable, but if its foundation, its balance sheet is weak, it's just a house of cards waiting to fall over. And when we talk about financial health, we're mostly talking about debt. This slide is the perfect way to see what debt really does. It's an amplifier. Just look at these tables. In the top scenario, when sales go up, the low debt company sees its profits rise by 25%. Pretty good. But look at the high debt company. Its profits rocket up by 50%. Amazing, right? But now, look at the bottom scenario. When sales fall, the low debt company's profits drop by 25%. The high debt company's profits completely crater, falling by 50%. Debt magnifies everything, the good and the bad, which makes the business way, way more risky. Which brings us to our final diagnostic step before we summarize everything. You have to actively look for what could go wrong. You have to build what's called a bear case. Ask yourself, why might somebody want to sell this stock? What are the hidden dangers I'm not seeing? Here's a great cautionary tale from the source material. An investor buys shares in a company called Ballantine, and they make movie projectors. The business itself looks really solid, it's growing, not a lot of competitors. Seems like a pretty good bet. But there was a risk hiding in plain sight. You see, the problem wasn't Ballantine. The problem was its customers. The entire movie theater industry was on this crazy debt-fueled building spree that was about to end very, very badly. And when the movie theater chains went bust, they stopped buying projectors, and Ballantine's seemingly solid business crashed right along with them. It's a painful lesson, but a powerful one. You have to look beyond the company itself. Okay, we have completed our full medical checkup. We've looked at growth, we've looked at profitability, financial health, and the big risks. So now, let's put it all together into a final prescription, your very own investor's checklist. Here it is. This is the practical tool you can walk away with and start using today. Always know where the growth is coming from. Be super skeptical of that manufactured earnings growth. Look for high efficiency with ROA and solid profitability with an ROE consistently above 10%. Go for companies that actually produce cash, not just burn it. Stay away from too much debt, and never, ever, ever invest in anything without first building a solid bear case. Think of this checklist as your shield. It's what protects you from falling for a company that only looks good on the surface.
Following these steps, using this checkup, will put you miles ahead of most investors out there. It'll help you find high-quality, fundamentally healthy businesses. But that leads us to the next million-dollar question. Finding a great company is only half the battle. How do you know if you're paying a fair price? But that is the art of valuation, and that is a topic for another day.
So when you're looking at a stock, it's easy to get lost in the numbers, right? The earnings, the revenue, the PE ratios. But what if I told you the single most important factor can't even be found on a spreadsheet? Today, we are going deep on the people running the show, the management team. These are the folks who can take a company to the moon or, well, run it straight into the ground. Let's start the investigation.
Yeah, this really hits the nail on the head, doesn't it? We can stare at financial models all day long, but at the end of the day, we are handing our money over to the people in the C-suite. Their judgment, their integrity, their skill, that's what's steering the ship. The stakes for our investment, they literally couldn't be higher.
Okay, so this is the big question, right? The one I get all the time. It feels kind of impossible. How on earth can you assess someone's character or competence if you can't sit down with them, look them in the eye? Well, I'm here to tell you that's a total myth.
That's right. You don't need a meeting because nobody, and I mean nobody, can run a public company without leaving a massive paper trail behind them. So yeah, time to put on that detective hat. Your job isn't to be a psychic, it's to be a detective, following the clues in public documents to build a rock-solid case file on who's really in charge.
So here's our mission briefing for today. We're going to crack open 3 crucial case files to build our profile. First, we'll follow the money and look at compensation. Second, we're going to judge their character. And third, we'll dig into their operations to see if they can actually deliver. And at the end, I'll give you your very own investor's detective kit to take with you.
All right, let's crack open our first case file, following the money. Honestly, this is often the easiest and most revealing part of the whole investigation because the evidence is right there in black and white. How a team pays itself tells you pretty much everything about their priorities.
So what's your number one tool for this? It's called the proxy statement, or if you want to get official, SEC Form DEF 14A. You can find this online for free for any public company. And trust me, this document is an absolute goldmine. It lays out the salaries, the bonuses, the stock options, and all the juicy details on perks and performance targets.
So, you've got this document open. The first question to ask is super simple. Just look at the total pay package and ask yourself, is this reasonable? You really just have to use your gut here.
And to give you some perspective, just look at this. About 20 years ago, the average CEO of a big company made around 40 times what their average worker did. Fast forward to today, that number has ballooned to about 500 times. So when you see a pay package with 8 or 9 figures, it's totally fair to ask if it really, truly feels earned. And that brings me to a really simple rule I use. I call it the cringe test. If you read how much an executive is making and it literally makes you cringe, it's probably too much. A perfect example? A retired co-CEO of Verizon, after leaving the company, got a consulting gig for $250,000 a month. That is a shareholder-funded retirement plan, and it's a massive red flag.
Okay, this next red flag is a little sneakier. See, almost every company on the planet will tell you they believe in pay for performance, but your job as a detective is to see if that's actually true. And a huge tell is when you see the board of directors change the rules of the game halfway through, especially when it looks like the CEO is going to miss their target and lose out on a fat bonus.
And here is a classic example, Exhibit A, if you will. Back in 2001, Coca-Cola's board just lowered the bar for their CEO. The goal was 15% earnings growth over 5 years. When it started looking a little tough, they just changed it to 11%. The reward was the same, but the task got easier. That tells you this is a board that's not willing to hold management's feet to the fire. Another one to watch out for is when the performance goals are so incredibly vague that it's like shooting at the side of a barn. You just can't miss. They write these things to give themselves maximum wiggle room so they can justify a big payout no matter what actually happens.
Oh, and if you want the poster child for this, look no further than Disney back in 2001. Their proxy setup bonus could be based on net income, or adjusted net income, or return on equity, or adjusted return on equity. You get the picture. They could just pick whichever number looked best at the end of the year. And the best part, they said the actual target was confidential. Yeah, confidential, because they didn't want you to see how low the bar was.
All right, this next one is really dangerous. We're talking about paying huge bonuses just for completing an acquisition. This creates a terrible incentive for executives to just do deals, any deals, because they get paid for the act of buying something, not for whether that purchase ever makes a dime for shareholders. It's all about building an empire, not building value.
And yep, here's Exhibit C coming to us again from Disney. They paid out special bonuses just for getting the Fox Family Worldwide deal across the finish line. This is just a horrible incentive structure. A much smarter way to do it? Wait a few years and then pay a bonus only if the acquisition actually turns out to be a home run for the company's owners.
All right, let's close the book on compensation for now. It's time to dig into something a little less black and white. Case file number 2, character. Pay is a great first test, but there are other critical clues we need to look for to figure out if these are people you can actually trust with your money.
What you're really looking for here is a pattern. You've got two kinds of leaders. On one side, you have the candid ones. They're honest about mistakes, they take responsibility, and they just focus on the business. Then you've got the other side, the promotional types. They're always pumping the stock, acting like they're the only ones who can save the company, and whining that the stock is undervalued. Look, their job is to run the business well. If they do that, the stock price will take care of itself.
So where do you actually find all this stuff? Well, think of this table as your detective's checklist. In the annual 10K report, search for related party transactions. That's code for insiders doing deals with themselves or their family. In the proxy, see if the board is just a bunch of buddies who will never challenge the CEO. But I really want you to focus on that last one, ownership. You have to dig into the footnotes of the proxy to see if executives own actual shares or just a mountain of stock options. Now, options are great, but they don't have the same downside risk. Owning actual shares, that's what you want to see. That's real skin in the game. That means they win when you win and they lose when you lose.
Here's a really powerful and kind of counterintuitive sign of great character. Look for a management team that's willing to make a decision that actually makes their quarterly earnings look worse. For example, giving out restricted stock instead of options, because the stock has to be properly expensed. It shows they care more about being transparent and running the business for the long haul than they do about playing games to make the next quarter's numbers look good.
And that brings us to our third and final case file. Look, having execs who are paid reasonably and have good character is great, but they also have to be good at their jobs, right? They need to be able to actually run the business well. So how do we figure that out?
So here's a simple 4-step process you can use to get a handle on their skills. First, hit the financials. Are metrics like return on equity and return on assets high and getting better? That shows they're using capital well. Second, play historian with their mergers and acquisitions. Did those big deals that did a few years ago actually make money? Third, track the share count. If it's always going up, it means your piece of the pie is getting smaller. And fourth, check their follow-through. Pull up an annual report from 5 years ago. Did they actually do what they said they were going to do?
So, when you see these traits come together, you start to see a picture of a really great operator. They have the guts to go against the crowd when they know it's the right move. They're honest about the parts of the business that aren't working. They're smart and flexible with the company's money. And most importantly, their eyes are always on the long-term prize, not just on hitting a number for the next 3 months.
All right, we've covered a ton of ground, so let's pack up your official Investor's Detective Kit. These are the key takeaways. Your number one goal is to find teams that act like owners, not just hired help. Use that proxy statement, that's your secret weapon, to see if pay really is for performance. Steer clear of companies with those big character red flags, like self-dealing. Make sure they have real skin in the game through stock ownership. And finally, if you ever hear a manager say, "We don't disclose that," your alarm bells should be ringing. That's usually code for, "You wouldn't like the answer if we told you."
So there you have it. You've got the tools, you've got the framework. You are officially a corporate detective. You know where to look, you know what to look for, and you know the right questions to ask. That paper trail is out there, just waiting for you. Because the very best investors, they don't just analyze the business, they analyze the people running it. So the only question left is, which company's management will you investigate first?
Welcome to The Explainer. Today, we're going to equip you with a financial detective's toolkit. We're going to learn how to see past a company's official numbers and spot the telltale signs of deception before it can cost you. So, let's kick things off with the one question every investor has to ask themselves. Are the profits a company is reporting the real deal from a solid, growing business? Or are they just a clever magic trick, some kind of illusion cooked up by accountants? It's a huge distinction because one builds your wealth and the other, well, it can absolutely destroy it.
Now, to really get a handle on this, you need to understand that there are two levels of fakery we're looking for. On one hand, you've got what's called aggressive accounting. This stuff is technically legal, but it operates in a really shady gray area, and it's almost always designed to make things look better than they are. And then on the other hand, you have outright fraud. That's not a gray area at all. It's illegal, plain and simple. All right, so here's our game plan for today. We'll start with the accounting smokescreen, which is where all this fakery begins. Then we'll cover the golden rule for every investor: follow the cash flow. After that, we'll dig into common patterns of deception, the people you need to watch, and some other hidden dangers, before we wrap it all up with a really practical checklist you can use. Okay, let's jump right in. Before you can spot the tricks, you've got to understand the stage where the magic show happens, and that's the world of accounting itself. You see, the fundamental issue here is that accounting isn't just simple math. It's full of estimates, assumptions, and judgments. Think about it. How long is a new piece of factory equipment going to last? 10 years? 12? 15? That one single decision changes the profit number the company reports today. And this kind of flexibility creates dozens of perfectly legal loopholes that let a company create the illusion of progress when all they're really doing is shuffling numbers around on a spreadsheet. Okay, now for our first and honestly our most important tool. This is the one piece of evidence that's the hardest to fake. Seriously, if you learn nothing else from this, master this one concept. You have got to follow the cash. This right here, this is the single biggest red flag in corporate finance. You look at the income statement and you see net income just climbing and climbing quarter after quarter. But then you flip to the cash flow statement and you see the actual cash the business is generating is flat, or even worse, it's falling. What does this mean? It usually means the company is booking sales on paper without actually getting paid, all to hit Wall Street's profit targets. So let's look at a classic case file to see this in action. The story of the former telecom giant Lucent Technologies is a perfect, and pretty scary, example of what happens when reported profits and actual cash tell two totally different stories. Just look at how huge this disconnect is. Between 1997 and 1999, Lucent's reported net income exploded, going up almost eightfold. On paper, they looked like one of the hottest companies on the planet. But, and this is a huge but, at the exact same time, their cash from operations completely fell off a cliff, plunging from over $2 billion in the bank to burning through $276 million. The profits were just an illusion, built by doing things like lending money to risky customers so they could buy Lucent's products. So the crucial point here is that old saying, profit is an opinion, but cash is a fact. Net income can be twisted and turned with all kinds of accounting assumptions, but cash flow, that's much, much harder to fake. Over the long run, those two numbers should move together. If you see them going in opposite directions, your alarm bells should be ringing off the hook. Okay, let's move on. Now we're going to look for patterns of behavior. Companies that seem to make these confusing financial moves over and over again, making it almost impossible to get a clear picture of what's really going on. First up, you have to be wary of what we'll call serial chargers. These are the companies that almost every year seem to have some massive one-time restructuring charge. The problem is all these constant one-time adjustments make their financial history a complete mess. It's like trying to drive a car while someone keeps splattering mud on your windshield. You just can't get a clear view of where the business has been or where it's headed. So here's how this little trick works. Management knows there's some bad news coming, say some big layoffs or shutting down a failed project. Instead of letting those expenses hurt their numbers in the future, they package it all together and take one gigantic financial hit today. They call it taking a big bath. Sure, the current quarter looks terrible, but it completely clears the slate, which makes all the future quarters look artificially clean and profitable. And in a similar vein, you have to be really cautious with serial acquirers. These are the companies that are just constantly buying other companies. The thing is, every time they make a big acquisition, their financial statements have to be completely redone and rejiggered. This makes it nearly impossible to figure out how the original business is actually doing, because you can't make a simple apples-to-apples comparison from one year to the next. It's basically a shell game that can hide a lot of problems. All right, so in this next part, let's shift our focus from the patterns in the numbers to the people behind them. We'll look at the corporate watchmen, and then we'll dive into two common places where big financial problems can hide in plain sight: money owed by customers and money owed to employees. There's this ancient Latin question that asks, who watches the watchman? And man, that question is perfectly suited for the world of corporate finance, where we have to trust certain people to be the guardians of the truth. So who are the watchmen in a company? Well, you're talking about the chief financial officer, the CFO, and the company's external auditors. It's their job to make sure the numbers are accurate. Now, people change jobs all the time, but if a CFO suddenly quits out of the blue or a company abruptly fires its auditing firm, that can be a massive signal that something's wrong behind the scenes. It might just mean the watchman saw something they didn't like.
This chart shows another critical warning sign. You need to keep an eye on the gap between how fast sales are growing and how fast accounts receivable is growing. And accounts receivable is just a fancy term for the money customers owe the company. It's their pile of IOUs. When that pile of IOUs grows a lot faster than sales, like you see here, it's a huge danger sign. It usually means the company is desperately trying to make sales by extending credit to sketchy customers who might never pay up. And finally, here's a place where massive problems can hide that very few investors ever look. The pension footnote in the annual report. Just take a look at General Motors way back at the end of 2002. They had promised their retirees $80 billion in benefits, but they only had $61 billion in assets to pay for it. That $19 billion hole, that's a gigantic anchor that will drag on the company's finances for years, sucking up cash that could have been used to grow the business. All right, for our final round of investigation, let's do a quick lightning round to uncover some of the more advanced but just as dangerous traps that companies use to polish up their financial results. Remember our golden rule about cash flow? Well, you can't just look at the total number. You have to know where that cash is coming from. Watch out for vanishing cash flow. As you can see here, back in 2001, a whopping 40% of Sun Microsystems' operating cash didn't come from selling their products. It came from a tax benefit they got from employees' stock options. The problem? That source of cash completely depends on a rising stock price. When their stock crashed, that cash flow, poof, it vanished overnight. And keep your eyes peeled for these other tricks. Overstuffed warehouses? That just means inventory is piling up way faster than sales, which is a sure sign that demand is weak. Some companies will use a one-time gain from an investment to make their core business look better. Others might count temporary stock market gains in their pension plan as if it's recurring profit. And a real classic is capitalizing costs. This is where they take a normal, everyday expense, like marketing, and pretend it's a long-term asset, all just to push costs into the future and make today's profits look bigger. So, to bring this all together, here is a simple but really powerful checklist you can use. 1. Always compare the trend in net income to the trend in cash flow. 2. Be super skeptical of serial acquirers and companies with constant one-time charges. 3. Watch accounts receivable like a hawk to make sure it isn't growing way faster than sales. And 4. Learn to separate real core business success from flaky one-time gains from things like investments or pensions. We'll leave you with this final thought. A company's financial report is a story. It's the story that management wants to tell the world. But now you have the tools to be more than just a passive reader of that story. You can be a detective. You can interrogate it, look for the plot holes, and decide for yourself if what you're reading is a work of fact or a very expensive piece of fiction. Welcome to The Explainer. Have you ever looked at a hot stock and wondered, is this for real or is it all just hype? Well, the answer to that question is a skill, and it's one of the most powerful skills in all of finance. It's called valuation. Today, we're going to build your investor's toolbox from the ground up so you can learn to see what a business is really worth. You know, this one simple idea is the absolute foundation of successful investing, and yet it's the very first thing we all forget when a stock is shooting for the moon and everyone's getting excited. Just remember this. It doesn't matter how amazing a company is, if you overpay, your returns are going to suffer. This is our guiding light for everything we're about to cover. So, to really get a grip on valuation, we first need to draw a very clear line in the sand. Okay, on one side, you've got the investor. Their return, their success, is tied directly to how well the actual business does. They do the homework, and they get to share in the company's success. But on the other side, you have the speculator. And honestly, they couldn't care less about the business. Their whole game is just about finding someone else, the so-called greater fool, who's willing to pay an even higher price down the road. It's a bet on moods, not on fundamentals. All right, here's our game plan.
First, we're going to dig into why the price you pay is absolutely everything by looking at the two sources of stock returns. Then, we'll start building out your toolkit with metrics like price to sales and price to book before we tackle the big one, the famous PE ratio. After that, I'll show you a powerful mental trick, thinking in yields, and then we'll wrap it all up with a handy investor's checklist you can start using right away. So, where do stock market returns actually come from? It turns out your profit isn't just one number. Nope, it's a mix of two totally different forces, and understanding that difference is really the key to protecting your portfolio. Okay, think of your total return like this. You've got the investment return, which is what the business itself is giving you. We're talking dividends in your pocket and actual growth in its earnings. That's the solid, reliable part. And then you've got the speculative return. This part is all about market psychology. It's this unpredictable wave of human emotion that decides if people are willing to pay more or less for those exact same earnings, which we see when a stock's PE ratio goes up or down. And wow, this slide right here shows us what really matters in the long run. Across the entire 20th century, the U.S. stock market returned about 10.4% a year. But just look at where that came from. A whopping 9.8% of it came from how the businesses actually performed. Dividends and earnings. Just a tiny, tiny fraction came from speculation. The message couldn't be clearer. Over the long haul, the business is what counts. But in shorter time frames, the story can get completely flipped on its head. During that epic bull market from 1980 to 2000, the businesses underneath were still chugging along, delivering a solid 10% return. But look at this. Another 7% per year came just from pure speculative optimism. Investors were just willing to pay more and more for the same dollar of earnings. That's a huge boost, for sure, but it's like riding a wave, and what goes up can definitely come crashing down. And this is the perfect cautionary tale. In the 1970s, American businesses were absolutely on fire, delivering an incredible 13.4% investment return every single year. But guess what? It didn't matter. The market mood soured big time after the Nifty 50 craze, and when that bubble burst, PE ratios just collapsed, creating this crushing negative 7.5% speculative return year after year. It wiped out more than half of the real business gains. This, right here, is exactly why valuation is your shield against market madness. Okay, so this brings us to a really critical point. You can't control what the market feels, but you can control the price you're willing to pay. And to do that well, you need the right tools. So let's start building our toolkit with two of the basics, price to sales and price to book. Our first tool is the price to sales ratio, or PS. And the great thing about this one is its simplicity. It just asks a straightforward question. For every single dollar of a company's sales, how much am I paying? A big plus here is that sales numbers are usually pretty clean, and aren't as affected by the kind of accounting tricks that can sometimes mess with earnings. The PS ratio is really handy when a company's earnings are all over the place. Maybe it's a cyclical business like a car company, or it's temporarily losing money. But it has one fatal flaw, and it's right there in the name. It only looks at sales and completely ignores profits. $1 of sales at a low-margin grocery store is not worth anywhere near the same as $1 of sales at a high-margin software company. This is why comparing PS ratios across different industries is a classic rookie mistake. And this slide gives us a perfect real-world example. Just take a look at Motorola back in the late 90s and early 2000s. For 3 of these 5 years, the company was actually losing money, which makes the PE ratio completely useless. But the price-to-sales ratio? It gave us a nice, steady yardstick. An analyst could look at this and see that a PS of 0.7 back in 2002 was a bargain compared to its history, even when the earnings were in the red. All right, next up in the toolbox is the price-to-book ratio, or P/B. This was a favorite of the father of value investing himself, Benjamin Graham. The idea here is really simple. Let's forget about trying to predict the future. Instead, let's just see what the company is worth on paper right now based on its hard, tangible assets. PB is still really great for valuing businesses that are built on physical stuff. Think of a bank with its loan portfolio or a big manufacturer with its factories. But for modern knowledge-based companies, it's pretty much useless. Trying to value eBay with this metric completely misses its most valuable asset, the network of buyers and sellers. Same goes for a company like 3M. This ratio ignores the power of its brands and all of its patents. Okay, it's time to talk about the superstar of valuation metrics, the price-to-earnings ratio,
or PE. It's the most famous number in finance, which, of course, also makes it the most misused. So to use it right, you really have to understand its hidden traps. Now, the PE is popular for a good reason. It asks a simple but really powerful question. How many dollars are investors willing to shell out today for just $1 of a company's annual profit? And because earnings are what really power a business, the PE ratio often gives us a much better sense of value than sales or assets do on their own. But here it is, the number one mistake people make with the PE ratio. A PE of, say, 12 means absolutely nothing by itself. It could be a total steal for a fast-growing, stable company, or it could be a value trap for a risky business that's not growing at all. The number is useless without context. It all comes down to the company's growth, its level of risk, and how much cash it needs to keep running. So if you want to use the PE ratio without getting burned, you have to put on your detective hat. And your first job is to investigate the E, the earnings. Is the number you're looking at a true picture of the company's real ongoing earning power, or is something fishy going on? Here are 4 common PE traps you have to watch out for. Trap number 1, one-time gains. Did the company just sell off a big division? That can make earnings look huge for a year and make the PE look deceptively low. Trap number 2, cyclical peaks. A car company might have a super low PE right at the top of an economic boom. That's usually a warning sign, not a bargain. Trap 3, big write-offs. A huge one-time charge can make earnings vanish, making the PE look sky high. And trap 4, accounting differences. How a company accounts for its spending can really change reported earnings, so you gotta be careful comparing across industries. All right, now for a simple but, incredibly powerful shift in how we think about this. So far, we've been looking at ratios with price on the top. But what happens if we just flip them upside down? We get yields. And thinking in yields is a total game changer because it lets us compare a stock's potential return directly against other investments, like a safe government bond. The most powerful yield metric out there is called cash return, and it answers a very practical question. If I bought this entire company today, I'm talking its stock, all its debt, the whole shebang, what would my immediate cash return be? It does this by comparing the free cash flow, that's the actual cash the business has left over, to the enterprise value, which is the true all-in cost to buy the entire company. So let's just walk through a real example here with Clorox back in 2003. First, we figure out the enterprise value. We take its stock market value, we add all its debts, and then we subtract the cash it has sitting around. That gives us a total price tag of $10.1 billion. Okay, then we look at its free cash flow for that year, which was about $600 million. We just divide the cash it generated by the price we pay, and boom, we get a cash return of 5.9%. Now, that 5.9% number, that becomes our anchor point. At that same time, a super safe 10-year government bond was only paying about 4.5%. So Clorox was offering a much higher return to pay you for taking on business risk. And as you can see from this table, that cash flow wasn't some fluke. Clorox had a decade-long track record of consistently generating strong and growing free cash. That context makes that 5.9% yield look like a pretty compelling deal. All right, we've covered a ton of ground and we've filled up our toolbox with some really powerful concepts. So now let's just boil it all down into a simple, actionable checklist to help guide your own analysis. Okay, first, and this is the most important thing, always remember our guiding star. Be disciplined about the price. A great company bought at a bad price is a bad investment, period. Second, never ever rely on just one metric. Each tool has blind spots, so you need to use them together to get the full picture. Use the PS ratio when earnings are a mess, and then turn to the PB ratio for those asset-heavy businesses like banks and manufacturers. Now, when you're using the PE, the best comparison is often the company's own history. And be really, really careful with simplistic shortcuts like the PEG ratio. It tries to link PE to growth, but not all growth is the same. And finally, always translate your valuation into a yield. Comparing a stock's cash return to the safety of a bond is the ultimate reality check for any investment you're thinking about making. So here's the bottom line. Valuation isn't about being boring or trying to avoid exciting companies. Not at all. It's the discipline that acts as your shield against market craziness. It's that line in the sand that separates calculated investing from just pure speculation. You now have the foundational tools to analyze a business, not just its stock price. So the only question left is, are you ready to be an investor?
Welcome to The Explainer. Today we're going to tackle one of the biggest questions in all of investing, one that really separates just speculating from having a disciplined, business-focused approach.
So, what is a stock really worth? A lot of us, maybe you too, immediately look at things like the PE ratio, right? But here's the thing. That whole approach, it's got a huge drawback.
See, the thing about ratios is they're all about price. They're comparing what you pay for a stock to its earnings or its sales. But they tell you, well, absolutely nothing about a company's intrinsic value, what that business is actually truly worth. And that's the whole problem, isn't it? Without knowing the value, how on earth can you know if the price is a good deal?
To answer that, we need a better way of thinking. So here's the game plan for today. We're going to start with the foundational rule of value, then learn how to do a little time travel with our money, build a simple valuation model, and then figure out how to use all that to make much smarter investment decisions.
All right, let's kick things off with that golden rule. And the good news is we don't have to start from scratch here. We can, as they say, stand on the shoulders of giants, economists who already figured this all out for us decades ago. This sentence right here, this is it. This is the bedrock of all valuation. It really forces you to stop obsessing over the little ticker flashing on the screen and start thinking like you own the entire business. The real question then becomes, if I own this whole company, lock, stock, and barrel, how much cash would it spit out for me over its entire lifetime?
Okay, so to really get what that rule means, we have to pull it apart. There are two key phrases in there we absolutely have to unpack: future cash flows and present value. Honestly, if you get these two things, you've got it all.
First up, let's talk cash flow. And I'm not talking about some fuzzy accounting number like profit or revenue. No, we're laser focused on free cash flow. This is the real, actual cash left over after a company pays all its bills and makes all the necessary investments to keep running. It's the money you could literally take out of the business to pay a dividend or buy back stock. It's what gives a business its worth.
All right, now for that second piece of the puzzle, present value. This is where we get into a little bit of time travel. See, $1 you're promised a year from now just isn't worth the same as $1 in your hand today. But why is that?
Well, it really boils down to two super powerful but pretty simple ideas. First, opportunity cost. $1 today can be put to work, invested to earn a return. $1 you won't get for 5 years, you can't do anything with it in the meantime. Second, and this is a big one, risk. A promise of a future payment is just that, a promise. The company could get into trouble. So we need to be paid for that uncertainty.
So we take these two ideas, the waiting game and the risk, and we bundle them into one number. We call it the discount rate. Just think of it like this. It's the return you demand to make it worth your while to wait for your money and take on the risk that you might not get it. It makes sense, right? A riskier company is going to get a higher discount rate. This vacation analogy on the slide, it's a fantastic way to wrap your head around this. Imagine your boss asks you to push back a 5-day vacation for a whole year. You'd probably ask for an extra day off next year, right? That's you getting compensated. Your personal discount rate for that trip is 20%. Now, what if you think your boss might get fired, making that promise a little shaky? Whoa, the risk just shot up? You might demand 2 extra days. Now your discount rate is 40%.
And this is where it gets really interesting. Look at how powerful this all is in practice. You've got 3 companies here. Get this, they all generate the exact same amount of cash over 10 years, about $32,000. But look at StableCorp. It's predictable, so it gets a low 9% discount rate. Its value today, almost 21 grand. Now look at RiskCorp. It's riskier, its cash comes later, so it gets a 15% discount rate, and its value today plummets to just over 12,000. The timing and the riskiness of cash, it's absolutely everything.
Okay, enough theory. Let's roll up our sleeves and get practical. How do we actually put all these pieces together and calculate a real value? Well, the tool for the job is called a discounted cash flow model, or what you'll hear called a DCF.
Now, the models the pros use can get insanely complicated, but the basic logic, the engine behind it all, follows these 5 simple steps. First, you got to guess the future cash flows. Second, you use your discount rate to pull those future values back to today. Third, you have to estimate the company's value way out into the future. Fourth, you add it all up. And finally, you divide by the number of shares to get a value for each share.
Okay, but what about step 3, perpetuity? I mean, we can't just pretend a company vanishes after year 10, right? So to capture all the value from year 11, basically forever, we use this simple little formula. that just assumes the company will grow at some slow, steady rate for the long haul.
And here's exactly how that formula works. It's actually pretty straightforward. You take that last cash flow you projected, you grow it one more time by that long-term rate, and then you divide that by your discount rate minus that growth rate. That gives you one single number for all of those future cash flows, which you then, of course, have to discount back to today's value.
All right, let's see the whole thing in action with this real-world example for Clorox. You can see our 5 steps laid out perfectly right here. Step 1, we forecast the cash flow. Step 2, we discount each one of those back. Step 3, we figure out that big perpetuity value and pull it back to today. And then steps 4 and 5 are the easy part. We just add it all up and divide.
So after we run all the numbers, and remember, we were being pretty conservative here, with 5% growth and a 9% discount rate because Clorox is just a super stable business, we land on an estimated intrinsic value of $54.30 a share. Okay, so we've got our number, $54.30. We have an estimate of what the business is worth, but hold on. This does not mean we just go out and buy the stock. Nope. In fact, what comes next is probably the single most important part of the entire process for any disciplined investor.
And this brings us to the timeless wisdom of the great Benjamin Graham, who is basically the father of value investing. He taught that the real secret isn't just about being a math whiz and calculating a value. It's about building in a buffer, just in case you're wrong.
So let's jump back to our Clorox example. Our model spits out a value of about $54, but at the time, the stock was trading for just $45. I mean, on the surface, that looks like a fantastic deal, right?
So is it a slam dunk? An immediate no-brainer buy? Not so fast. Because we have to have a little humility here. Our valuation, it's just an estimate. It's a guess. An educated one, sure, but still a guess about a future that's totally uncertain. We could be wrong.
And this is where the margin of safety comes into play. It's exactly what the slide says. It's your insurance policy against being wrong. It's the gap between the price you pay and the value you've calculated. By insisting on buying at a big discount to what you think it's worth, you protect yourself. It's your financial cushion. If your forecast was way too optimistic, that discount is there to soften the blow.
So, finally, let's just be real for a second. What does it actually mean to adopt this kind of disciplined, value-first approach? Well, like any strategy, it's not all sunshine and rainbows. There's a trade-off. So what's the downside? Well, yeah, by being super strict about the price you pay, you're probably going to miss out on some of those incredible rocket ship growth stories. I mean, companies like Microsoft or Starbucks looked crazy expensive for years, and this approach probably would have kept you on the sidelines. But the upside? The upside is so much more important. You will sidestep the massive graveyard of companies that were priced for greatness, but ended up being total duds.
And that, right there, is the ultimate takeaway. Valuation isn't just a spreadsheet exercise. It's a whole mindset. It shifts your focus from a stock story to its substance. It forces you to remember that the sharp pain of losing money is so much worse than the dull ache of missing out on a gain. So it leaves you with a really simple question. Are you playing the price game, or are you playing the value game?
All right, let's get right into it. Imagine you've got 2 companies in front of you. One is this flashy, high-tech chip maker right in the middle of all the action. The other, a super steady, almost boring medical device company. So which one is the better investment? You might think the answer is obvious, but it's almost never in the big, splashy headlines. Nope, the real secrets are buried in the numbers. And today, that's exactly what we're going to do. We're going to go digging. We'll use a powerful investment framework to break down 2 real companies, AMD and Biomet, piece by piece. The goal here isn't just about picking a winner. It's about learning the process, Learning how to separate a good story from what's actually a great investment.
So here's the game plan for today. First, we'll go over our investor's checklist. This is basically our toolkit for the investigation. Then, we dive into case number 1, advanced micro devices, and we'll see what the verdict is. After that, we do the exact same thing for case number 2, Biomets. And to wrap it all up, we'll put everything together, from the data to the final decision. Simple as that.
Okay, first things first. Before we even think about looking at a company's financials, we need a system, a plan. Why? Because in the world of investing, it is so easy to get distracted. You've got flashy new products, crazy headlines flying around, a stock price that's going to the moon. It's a ton of noise. A solid framework, a checklist, is the only way to cut through all of that and focus on what really truly matters, the actual health of the business.
And here it is. This is our 6-point checklist for every single company we look at. We're going to ask these 6 critical questions. Number 1, Does it have an economic moat? You know, some kind of lasting advantage that keeps competitors at bay. 2, is it growing? And, just as important, is that growth actually making money? 3, profitability. How is this company making its cash? 4, financial health. Is this business built on solid rock or on sand? 5, management. Are the people in charge working for the shareholders, that's you, or are they just lining their own pockets? And finally, the big one, number 6, valuation. What is this business really worth? Forgetting about the stock price for a minute. This checklist right here, this is going to be our compass for the entire journey.
All right, let's dive into our first case study, Advanced Micro Devices, better known as AMD. Now, we're calling this one the cautionary tale for a very specific reason. It's the perfect example of a company with a fantastic story, a story that, well, doesn't quite match up with the financial reality.
And I mean, come on, the story is awesome, right? You've got this high-tech chipmaker, AMD, and it's one of only 2 companies on the planet that makes the microprocessors, the brains inside our computers. It's a classic David versus Goliath story. You've got the scrappy underdog AMD going toe-to-toe with the massive giant Intel. And for a while there, AMD was even making chips that were faster, maybe even better. What's not to love about that setup? It sounds like the perfect investment story.
But, and this is a huge but, a great story just isn't enough. Not for a serious investor. We have to look past the narrative and dig into the cold, hard numbers. Because the financial statements, that's where a company can't hide. It's where its true character comes out, warts and all. So, what secrets are hiding in AMD's books? Let's find out.
And whoa, okay. The numbers immediately paint a very different picture from that exciting story. What you're looking at here is a decade of AMD's financial performance. Let's look at the chart on the left first. See that bottom row? Free cash flow? After a couple of okay years in 93 and 94, just look at that sea of red. Negative numbers from 1995 all the way through 1999. That means the company was literally burning through cash for 5 years straight. Oof. Now glance over to the chart on the right and find the return on equity line. Count them up. That's 6 years of negative returns. This doesn't look like a dominant business. This looks like a company that's just trying to keep its head above water.
So all that red ink brings us right back to the first item on our checklist, the economic moat. And based on this evidence, it's pretty clear there isn't one. Now, you might be looking at the year 2000 and thinking, hey, that was a great year. And it was. But that was just a fleeting moment. They had a temporary tech advantage. They made a better chip for a little while. But here's the thing. A temporary tech advantage is maybe the weakest kind of moat imaginable, especially when your main competitor is a giant like Intel that can outspend you 4-to-1 on research and development. Intel can just throw a mountain of cash at the problem until your tiny advantage completely disappears. And this slide, wow. This really shows the brutal squeeze AMD was in. This is what's called a common size income statement. All that means is that every number you see is a percentage of total sales, which makes it super easy to spot trends. Okay, follow the gross margin row with me. Back in 1993, it was a really healthy 52%. Now just watch it as you go across the years. It just gets eroded, all the way down into the 20s. So they're making less profit on every single chip they sell. At the same time, look at the R&D row. It more than doubles. They're spending more and more just to stay in the game. This is the classic sign of a company with zero pricing power. They're getting squeezed from both ends, making less money while being forced to spend more. It's an impossible situation. Okay, let's move on to checklist item number 5, management. And, well, this is where we find some pretty big red flags. First off, the CEO was pulling in $1 million salary plus big bonuses, even in years when the company was losing a ton of money. But what's even worse, in my opinion, is the shareholder dilution. Between 2000 and 2003, management handed out so many stock options that the total number of shares out there went up by 15%. Let that sink in. If you owned a piece of AMD, your slice of the pie just got 15% smaller. That's a huge signal that management is looking out for themselves, not for the people who actually own the company.
So, let's recap. We've looked at the business, and frankly, it's not a pretty picture. There's no real moat to speak of, profits are all over the place, and management seems to be taking care of themselves first. But hey, even a struggling company can be a fantastic investment if you can buy it for cheap enough. So that brings us to the final, crucial step, calculating what AMD is actually worth.
All right, time for the valuation, our last checklist item. We're going to use a tool called a discounted cash flow model, or DCF. It sounds complicated, but the idea is simple. We're trying to figure out what the company is worth today based on all the cash we think it's going to produce in the future. Now, given everything we've seen, the volatility, the lack of a moat, we have to be really, really conservative here. That means we're going to assume pretty modest cash flows going forward, and we're using a high discount rate of 14% to account for how risky this business is. And after we crunch all those numbers, you can see the result at the bottom. We get an estimated value of just $5.16 per share.
And that brings us to the final verdict on AMD. At the time of this analysis, the stock was trading for $12 a share. Our super conservative estimate of its value was just over $5, so the market price was more than double what we think it was actually worth. Look, could the stock price go up based on hype or a good news story? Sure, anything's possible. But from a long-term investment perspective, based on the fundamentals, there's just no margin of safety here. For me, that's an easy pass.
Okay, let's totally switch gears now and turn to our second company, Biomat. We're going to run it through the exact same 6-point checklist. Biomat is in the medical device world. They make things like artificial hips and knees. And let me tell you, as we're about to see, its financial story is from a completely different universe than AMD's.
First off, just look at the industry Biomat is in. It's incredibly attractive. You've got aging populations in developed countries, which means, well, more and more demand for things like artificial joints. But here's the real key. There are massive barriers to entry. Think about it from a surgeon's perspective. Once they are trained and comfortable with a specific company's products, they are very reluctant to switch. That creates what we call high switching costs, and it makes for a super stable, predictable business.
And when we pull up the numbers, wow, you can see exactly how that great industry position translates into just incredible financial results. I mean, this is the polar opposite of AMD. It's night and day. Look at the chart on the left at that free cash flow row. Remember all the red ink with AMD? Here, there are no negative years. It's just a beautiful, steady, upward march. Now look to the right at return on equity. It's consistently high, almost always above 15%. This is what the financial fingerprint of a dominant, high-quality business looks like.
So yeah, these numbers are basically screaming that Biomat has a wide, durable economic moat. Its free cash flow as a percentage of sales is consistently over 10%, which is fantastic. Its returns on capital are just stellar, and maybe most importantly, there's almost no volatility. The business is predictable. The only real hiccup in an entire decade was a one-time legal charge, and the company just bounced right back. This is the definition of resilience.
But wait a second. No company is perfect, and a good investor always has to play devil's advocate. We have to build what's called a bear case. We have to ask, what could go wrong here? For Biomat, there are definitely risks. The medical device industry can be a legal minefield, so litigation is always a possibility. Its international business isn't nearly as profitable as its U.S. operations. And of course, there's always regulatory risk. The government could make changes that squeeze those fat profit margins. We can't ignore these things. We have to factor them into our final valuation.
Okay, so we've established that Biomat is a really high-quality company. It's got a strong moat, but it also has some risks we need to keep in mind. And this all leads to the single most important question for any investor. We know the company is great, but is the stock a great investment at today's price?
All right, let's fire up that DCF model again. For our first scenario, we're going to be conservative. We'll say it grows strongly for 5 years and then slows down. And remember that discount rate we used for AMD? It was 14% because it was so risky. Well, because Biomat is so stable and predictable, we can use a much lower rate, just 9%. That reflects the lower risk. So, running those numbers, our conservative model spits out a value of about $21 a share. Now, at the time, the stock was trading for around $28. So based on this first look, it seems like it might actually be a little bit expensive.
But hold on. Given how strong Biomat's moat is it possible that assuming only 5 years of strong growth is just too conservative? Let's run a second scenario, a more optimistic one. Let's assume the company can keep up its high growth for a full 15 years before it starts to slow down. I think that's a pretty reasonable assumption for a business this good. And when we make that one change to our model, look at that. The estimated value jumps up to about $30 per share, which is almost exactly what the stock was actually trading for.
Okay, so we've put both companies through the ringer, using the exact same framework, and the financial data has told us two completely different stories. Now for the final step, let's put them side by side and make the contrast impossible to ignore.
And there you have it. This is where the power of that 6-point checklist really shines. Let's just run down the list. Economic moat. AMD's is weak, if it even has one. Biomat's is wide and durable. Financial health. AMD's is troublesome. Biomat's is pristine, with no debt. Management. AMD's team was overpaid and diluted shareholders. Biomat's was shareholder-friendly. And finally, valuation. AMD looked way overvalued, while Biomat looked pretty fairly valued. You just couldn't get two more different outcomes from the same consistent process.
So, when you boil it all down, this whole exercise wasn't really about whether you should buy AMD or Biomat. The real point was to show you the process. We just walked through a 6-point checklist that you can use on any company to cut through the noise, look past the exciting stories, and figure out what the numbers are really saying. This framework, it's your tool now. You have it. So the only real question left is, which company are you going to investigate next?
All right, let's just jump right in. If you're an investor, you totally know this feeling. There are literally thousands of companies out there to choose from. So where do you even start? It's a classic case of analysis paralysis. Well, today we're going to break down a really powerful tool to help you cut through all that noise. It's called the 10-minute test, and it's a rapid-fire filter to help you figure out which stocks are actually worth your precious time.
So, here's the game plan. We'll kick things off by explaining the test itself. Then we're going to walk through each step. First, how to clear out the obvious junk. Then we'll check if the business is healthy and if its financial foundation is solid. After that, we'll look for some sneaky red flags. And finally, we'll talk about what to do when a company actually makes it through the filter. It's a really logical process to get you from thousands of stocks down to just a handful of real contenders.
Look, the whole point of this test is speed and efficiency. It's not a magic bullet, but it's designed to help you immediately eliminate, I'd say, at least half of the stocks you look at right from the get-go. By tossing out the weaker ideas early, you free up all that time and mental energy to do a real deep dive on the companies that might actually be fantastic investments.
Now, before we dive in, a couple of really important caveats here. Think of these as rules of thumb, not absolute, unbreakable laws. There are always exceptions to every single guideline. The whole point is for this to be a starting point for your research. And you know the best part? All the data you need to do this is easy to find on free financial websites. Okay, first things first. Before we even start looking at performance numbers or anything fancy, we just need to avoid the junk. This step is all about immediately clearing out the absolute riskiest categories of stocks before they can even tempt you. So what exactly does junk look like? Well, we're talking about companies with teeny tiny market caps, anything trading on those sketchy, less regulated pink sheets. Also, you'll want to pass on foreign companies that don't file their regular financials with the SEC here in the US. And be really careful with recent IPOs. Think about it. Companies almost never go public unless they think they're getting a fantastic price from investors. The one big exception to watch for? Spin-offs. Those can be interesting because they're often established businesses just being set free from a bigger parent company.
Okay, here is a question that is so simple, but wow, is it powerful. It sounds almost too basic, right? But asking this will save you so much grief. These pre-profit companies, they're often wrapped up in these exciting stories about changing the world, but really, they're just highly speculative bets. And that quote really says it all. Investing in a company that has never, ever proven it can actually make money is basically the same as buying a lottery ticket. It's not really investing. The odds of a startup failing are just astronomical. So this simple rule helps you avoid blowing up your portfolio on a long shot.
All right, so we've filtered out all the obvious junk. That's step one. Now for the companies that are left, we have to ask a really important question. Is this business actually healthy? This is where we start digging for signs of stable, consistent performance. Now, this is crucial. You have to know the difference between accounting profit and actual cash. A company can show profit on paper, but if it isn't generating real cash from its day-to-day operations, that's a huge problem. It means that sooner or later, they're going to have to sell more shares, which waters down your ownership, or take on more debt. You've heard it before, but cash is king for a reason. Next up is a metric you're going to see all the time, return on equity, or ROE. Put simply, this just tells you how good a company is at turning your money, the shareholders' money, into actual profits. It's a fantastic measure of how profitable and efficient the business really is.
So what's a good number to look for? Well, as a general rule of thumb, you want to see an ROE of at least 10% for most companies, and maybe a little higher, like 12% for financial firms. But consistency is the key. You want to see them hitting these numbers year after year. And, this is the big one, always check how much debt they're using. A high ROE that's fueled by tons of debt is way riskier than one that's earned with a clean balance sheet. You also want to look for stability in their earnings. You know, when you see a nice, steady growth in profits, it tells you this is a stable business that really knows what it's doing. But if the profits are bouncing all over the place from one year to the next,
That could mean the industry's super volatile, or even worse, it might mean the company is just getting its lunch eaten by the competition.
A healthy operation is great, right? But it has to be built on a solid financial foundation. So now we're going to take a peek at the balance sheet to make sure the company isn't hiding any major cracks in its structure.
Now, debt isn't automatically a deal breaker, but it does mean you've got to put on your detective hat. If you see a company with a lot of debt, you have to ask these 3 questions. First, is the business stable enough to handle those interest payments? Second, is the debt trend going in the right direction? Is it going down? And third, can you actually understand it? If you look at their filings and it's a total mess of complex debt, it might be a good sign to just walk away. And that brings us to what's often called the holy grail of investing, free cash flow. This is the cash that's left over after a company pays for all the investments it needs to maintain and grow its business. This is the good stuff. It's the pure cash that can be used for dividends or buying back stock. It's what truly makes the business more valuable for you, the owner.
So normally, you want to see that free cash flow number being positive and growing. Simple enough. But there is one giant exception to this rule, and it's a big one you really need to understand.
Believe it or not, negative free cash flow can actually be a fantastic sign if the company is a high-growth machine that's reinvesting every single dollar it earns back into high-return projects. Just think about Starbucks or Home Depot in their early days. They weren't generating free cash because they were busy building new stores like crazy, which created enormous value down the road. So if the ROE is solid and you trust management, negative free cash flow can be a sign of incredible growth ahead.
All right, we are in the home stretch of the test. Now we're going to look for the more subtle, kind of sneaky warning signs, the things that might not jump off the page at first, but can hint at deeper problems.
This is a great one. Go and look at the number of shares outstanding over the past few years. If that number is shrinking, it's a fantastic sign. It means the company is buying back its own stock, which makes your slice of the pie bigger. But if the share count is consistently growing, say by more than 2% a year, that's a red flag. It means your slice of the ownership pie is getting smaller and smaller every year.
And finally, be super skeptical of companies that are always reporting one-time charges or special items. I mean, if these things happen year after year, they're not really one time, are they? It just makes the company harder to analyze, and it can be a sign that management is trying to sweep some bad decisions under the rug. So let's say you've run a company through this whole gauntlet, and it passes with flying colors. Well, first of all, congratulations. You might have just found a genuinely promising investment. But, and this is important, remember that this 10-minute test is just the beginning. Now the real work starts.
Passing the test just earns a company the right to a much, much deeper dive. This means you need to look at a decade of their financials. You need to read their big annual legal filing, the 10K from cover to cover, check the proxy statements to see how the executives are getting paid, read the last few glossy annual reports to get a feel for the company's story. And only after you've done all of that should you even start to think about what the stock is actually worth.
And that is the ultimate point of all this. The 10-minute test isn't really about finding a stock to buy in 10 minutes. It's about protecting your most valuable, non-renewable asset, your time. This process makes sure you focus all of your deep, analytical energy only on that small handful of companies that actually have a shot at being a great investment.
So there you have it. You now have a powerful, simple framework to quickly size up any potential investment you come across. The process is clear, the questions are sharp, and the whole goal is to make you a more effective and efficient investor. So the only real question left is, which company are you going to test first?
Okay, so if you're an individual investor, you know the struggle, right? There are thousands and thousands of stocks out there, but you've only got so much time in the day. It's a huge research challenge, and that's exactly why we're doing this. Think of it as your personal guided tour of the market. We're going to cut through all that noise and zero in on 4 specific areas where you can often find some of the most durable and profitable companies out there.
Now, before we kick off our tour, we've got to talk about our main landmark, the economic moat. It's a fantastic metaphor for a company's sustainable competitive advantage. You know, the special something that shields its profits from all the competition trying to break down the doors. You see, some industries just make it way easier for companies to build these massive, powerful moats. And that's exactly where we're headed today. So, here's the game plan for our tour. We're going to make 4 key stops. First up, the money middlemen. Then, the unseen business champions. After that, we'll look at the future of health, and finally, media's moated empires. And definitely stick around for the end, because we're going to pull it all together and build a mental map that you can use for your own investing. Ready? Let's dive in. All right, our first stop takes us deep into the world of banks and financial services. These companies are in an incredibly powerful position because, when you boil it all down, they are the middlemen from money itself. And being the essential go-between for cash, well, that can be a wildly profitable business. So how do they do it? Honestly, the model is surprisingly simple, but it is incredibly powerful. They take our money, the deposits in our checking and savings accounts, and pay us next to nothing for it. Then they just turn right around and lend that exact same money out as loans or mortgages at much higher interest rates. And on top of all that, they rake in a ton of money from fees and selling us all sorts of other financial products. And this quote, man, it just perfectly sums up the crazy power dynamic here. When you add up all the monthly service charges, the overdraft fees, all those little costs, some banks do so well that, well, depositors literally pay the bank to hold their money. That is just an unbelievable position for a business to be in.
Okay, and this is where you, as an investor, get an edge. Bank financial statements can be really confusing. They don't look like a normal company's. I mean, for a bank, debt is actually their raw material. It's our deposits. And they have these weird concepts like allowance for credit losses that you won't see anywhere else. This complexity makes a lot of investors just throw up their hands and skip the whole sector. But that's your advantage. If you take the time to learn what makes these companies tick, you're digging in ground that's way less picked over, which means you've got a better shot at finding great ideas. Now, let's head to our next stop.
Welcome to our second stop, the world of business services. This category is kind of a catch-all for all sorts of things. And let's be honest, it's not very flashy. So a lot of investors just passed it right by. But that is a huge mistake, because this boring sector is absolutely packed with some of the most profitable companies you've probably never even heard of.
I mean, seriously, just think about this for a second. Would you ever have guessed that a company whose whole business is designing, renting, and cleaning employee uniforms could create an enormous amount of wealth for its shareholders? It sounds so mundane. But believe me, the profits are anything but. This just brilliantly shows the hidden power you can find in this sector. And it's not just uniforms. You can find all these fantastic examples of niche firms that just totally dominate their corner of the world. You've got Cintas, the uniform company. You've got Moody's, which is absolutely essential for rating bonds, a critical part of the financial system. And then there's Equifax, which runs the credit scoring databases that the entire lending industry depends on. These aren't household names like Apple, but their competitive positions are just rock solid.
And once again, here's the advantage for you, the individual investor. Wall Street analysts love to put companies into neat, tidy little boxes, right? Well, these niche champions often just don't fit. Plus, they're usually self-funding, which means they don't really need Wall Street services. And what's the result? They get way less attention and way less hype. And less attention from Wall Street can mean more opportunity for you. All right, for our third stop, we're diving into healthcare. A lot like financial services, this is a sector with a really powerful long-term trend behind it. I mean, people are always going to need healthcare. This creates a fantastic tailwind for the whole industry, but this is also a sector where you absolutely need to tread carefully. Look, the core idea here is really simple, but it's incredibly powerful. As populations get older and as new treatments are developed, the demand for healthcare products and services is just set to grow for decades to come. This sustained demand means companies in this space can be super profitable, and even smaller firms can build some really durable economic moats. But it's a real balancing act. On the one hand, you have this incredible demand and huge profitability. On the other, you have some pretty big risks. You have to be careful with biotech firms. They can be like single product lottery tickets. And then you've got the whole regulatory environment, which is described as truly arcane. A seemingly small change in a government rule can have a massive, massive impact on a company's business. For the last stop on our industry tour, we're going to explore media. This is another area where, historically, companies have been able to build just incredibly wide moats. A lot of these businesses operate like a toll booth. They control access to information or entertainment that people are willing to pay for, day in and day out. So how do they build these amazing moats? Well, it comes down to a few key advantages baked right into the industry structure. Many media markets are natural monopolies or oligopolies. Think about it. How many daily newspapers does a single city really need? Probably just one or two. And then there's the massive power of their business model, subscriptions, which means they get paid upfront. And if you want to understand just how powerful this is, check out this quote. Can you imagine getting paid on January 1 for the coming year's work? That's just how so many media firms operate. Imagine starting your year with a huge chunk of your revenue already in the bank for work you haven't even done yet. It's a massive cash flow advantage that's almost unheard of in any other industry. Okay, so our guided tour is wrapping up, but the point of all this wasn't just to show you 4 interesting industries. The real goal is to give you a framework, an investor's mental map, that you can take with you on your own journey. Let's see how we can turn this into a practical tool. So here's the most important takeaway. This isn't about memorizing a bunch of facts about banks or media companies. It's about learning a process. Over the long run, great investing is all about building a mental database of how different industries actually work. This tour was just designed to give you a huge head start on building that database. And here's your toolkit. These 5 questions are what you should be asking about any industry you look into. 1, how do they actually make money? 2, how do they build those economic moats? 3, what are the weird, unique things about this industry? 4, how can you tell the winners from the losers? And 5, what are the hidden traps you need to watch out for? If you can answer these questions consistently, you're going to become a much more confident and successful investor. So we've walked through 4 really fascinating corners of the market, and now you have a map and a toolkit to guide you. The only question left is, which one of these industries are you going to investigate first?
You know, healthcare is one of those rare things. It's tied directly to our survival. It's a sector that can literally save your life, but let's be honest, it's also a massive, massive business, filled with some really unique risks and, well, incredible potential for profit. So in this explainer, we're going to pull back the curtain on the economics of healthcare and give you the tools you need to analyze it like a seasoned pro.
Okay, so here's the game plan. First, we're going to tackle why the business of health is just so profitable to begin with. Then, we'll dive into the major players. You've got the pharmaceutical giants, the high-stakes world of biotech, and the companies building the actual hardware of health, the medical devices. We'll wrap things up by looking at the insurance system and then finish it all off with a super handy investor's checklist.
So, first things first, what's the secret sauce? What makes the healthcare sector such a financial juggernaut? Well, the answer really lies in a few powerful, interconnected trends.
I mean, just look at this. The scale of this growth is, well, it's staggering. Back in 1980, healthcare wasn't even a tenth of the U.S. economy. Fast forward just 30 years, and it was on its way to being almost a fifth of the entire economy. This isn't just some steady climb. It's a fundamental reshaping of our economic landscape.
And that right there is one of the sector's superpowers, its resilience. Think about it. During a recession, you might put off buying a new car or skip that fancy coffee, but you can't really put off getting sick. People need healthcare no matter what the stock market is doing, and that creates this incredibly consistent demand. It's what makes the sector a defensive safe haven for investors when everything else is going haywire.
Okay, this brings us to a really crucial idea for any investor, something called an economic moat. Basically, it's a company's defense system against competitors, and in healthcare, these moats are exceptionally wide and deep. We're talking about the almost impenetrable wall of a drug patent or the mind-boggling cost of building a new hospital network. This is the structural advantage that locks in long-term profits.
So what's the payoff for having these wide moats and constant demand? This number says it all, a whopping 23% average return on equity. And get this, that was over a 5-year period that included a major economic recession. That's just incredible. So let's dive into the engine room of all that profitability, the pharmaceutical industry.
All right, let's talk about the big guns, the pharmaceutical companies. This is a world of massive investments, truly groundbreaking innovation, and a constant, high-stakes race against the clock.
I want you to just let this number sink in for a second. $800 million. That is the average, eye-watering cost to bring just one new drug to market. And here's the real kicker. Only about a third of the drugs that actually make it will ever even earn that money back. It's an enormous gamble.
In this image, this really shows you what that journey looks like. Think of it as a brutal, multi-stage gauntlet that can stretch out for up to 20 years. Look way over on the left. When a drug is first discovered, its probability of success is a tiny, almost invisible 0.05%. As it clears each hurdle, that probability creeps up.
But wow, it is a long, expensive, and incredibly risky road to that finish line.
So let's walk through this gauntlet, step by step. It all starts with years of preclinical testing on animals. If that goes well, it moves to Phase 1, a small test on healthy humans, just to make sure it's safe. Then, Phase 2 asks, does this thing actually work? Testing it on a few hundred patients. Then comes the big one, Phase 3. This is a massive, multi-year trial with thousands of people that chews up the biggest chunk of that $800 million budget. And even if a drug survives all of that, a mountain of paperwork goes to the FDA for a final review that can take on average another 17 months.
So, let's say a drug pulls off a miracle and makes it all the way through. The reward is a patent. But, and this is a huge but, there's a catch. That 20-year patent clock starts ticking near the beginning of this whole process, not the end. So by the time a drug finally hits pharmacy shelves, the company might only have 8 to 10 years left of exclusive, monopoly profits before it faces what everyone in the industry fears, the patent cliff. And trust me, this patent cliff is not just some abstract concept. It is a sheer drop. This is what it looks like. When the famous antidepressant Prozac lost its patent, its quarterly revenue fell off a cliff, dropping from $575 million to just $96 million in just 6 months. Generic competition comes in fast, and it is absolutely devastating to a drug's bottom line.
Okay, so if you're looking at a pharma company, what are the signs of a winner? How do you spot a durable business? Well, you want to see blockbuster drugs. We're talking over $1 billion in sales. But even more important is how much time is left on their patents. A pipeline that's full of new drugs in development is also absolutely essential to replace the revenue that's going to eventually fall off that patent cliff. And hey, never underestimate the power of a great sales team with strong doctor relationships.
All right, now let's pivot to biotech. And you can pretty much think of biotech as Big Pharma's younger, faster, and way more volatile cousin.
The thing about biotech is that it's not all the same. On one side, you have the established players, the big guys that look a lot like traditional pharma companies. They have billions in revenue, positive cash flow, full drug pipelines. But on the other end of the spectrum, you've got these speculative startups. These companies often have little to no revenue, they're just burning through cash, and they're pinning all of their hopes and dreams on one single idea. It's literally the difference between a solid blue-chip investment and a lottery ticket.
So, if you're brave enough to look at those up-and-coming biotechs in the middle, here are the 3 questions you absolutely have to ask. First, and most importantly, do they have enough cash? Clinical trials are wildly expensive, and they need enough money in the bank to see it through. Second, have they partnered up with a big pharma company? A partnership is a huge vote of confidence in their science. And finally, given the huge risk, is the stock cheap enough to offer you a margin of safety in case things go south? Okay, let's shift gears completely. We've talked about the drugs, now let's talk about the devices. This is the hardware of healthcare. We're talking pacemakers, artificial hips, surgical tools, and it's a space with some surprisingly powerful and long-lasting economic moats.
And one of the biggest economic moats you'll find here is something called high switching costs. Just think about it from a surgeon's perspective. They spend years, maybe even decades, mastering the procedure for implanting one specific company's artificial hip, using that company's special tools. For them to switch to a competitor's product, they'd have to go back and retrain. It's a huge hassle. So unless the new device is a total game changer, they're probably just going to stick with what they know.
Now, this is what I find so fascinating about the device market compared to pharma. The drug industry is this high-stakes, winner-take-all game where one revolutionary new pill can completely wipe out the competition. The device market? It's different. Innovation is usually more evolutionary, more incremental. This year's pacemaker is a little bit better than last year's. This makes the whole industry more stable and lowers the risk of a company getting completely blindsided by a competitor.
So, we've talked about the folks who make the cures and the tools. But who pays for it all? That brings us to the insurers and the managed care organizations. Their entire business is a really complex balancing act between managing risk and controlling costs. See, insurers have 2 basic ways of making money. The risk-based business is the classic model. They collect premiums and hope they pay out less in claims. They take on all the risk. But the real prize, the more stable business, is fee-based. This is where they just manage a health plan for a big company for a set fee, and the employer takes on the risk. As you can see, the companies that can shift more of their business into that predictable fee-based slice tend to have much better, much more stable results.
Now, if you want to know if an insurer is any good at their job, there's one number you have to know. It's called the medical loss ratio, or MLR. That sounds complicated, but it's not. It's basically just asking, for every dollar they take in from premiums, how much are they spending on actual medical care? A lower number means they're more efficient. With the industry average around 84–85%, any company that can consistently post a lower MLR is running a really tight ship.
Whew, we have covered a ton of ground, haven't we? From the crazy gambles of drug development to the nuts and bolts of insurance. So let's wrap this all up and boil it down to a final investor's checklist.
All right, here it is, your cheat sheet for analyzing the healthcare sector. First, always remember that drug development is a long, expensive gamble. For pharma companies, look for long patent lives and full pipelines. That's how they survive. Be really careful of any company that gets most of its revenue from just one blockbuster drug. As for speculative biotech startups, just avoid them unless you are a true expert. Don't forget about the powerful wide moats in medical devices. For any company doing R&D, cash is absolutely king. And finally, always keep an eye on the government. Regulations and spending decisions can change the game overnight.
And that really brings us to the big final question, doesn't it? For decades, this whole industry has been defined by the race for the next blockbuster patent, for the next full pipeline. But as technology moves faster and faster, you have to wonder, in a sector this vital, this complex, where is the next truly game-changing innovation going to come from? It's something to think about.
You know these names, right? Walmart, McDonald's, Home Depot, The Gap. We're in their stores, we're eating their food, we're interacting with these brands pretty much every single day. And that familiarity, it can feel like a secret weapon for investing. But, what's really happening behind the scenes, behind that cash register? Well, in this explainer, we're going to dig in and find out.
You've heard the old saying, right? Buy what you know. And it totally makes sense on the surface. I mean, you're the customer. You can see if the parking lot's packed, if the staff are on their game, if stuff is just flying off the shelves. But here's a thought. What if that insider knowledge, that feeling you have as a customer, is actually a bit of a trap? Today, we're going to pull back the curtain on the consumer services sector and see if what you see on the outside lines up with the financial reality on the inside.
Okay, so here's the thing, and it might surprise you. For every long-term giant like a Walmart, you've got dozens, maybe even hundreds of other retailers and restaurants that, well, they just burn incredibly bright for a moment and then, poof, they're gone. The reason? Most of these businesses have razor-thin competitive advantages, if they have any at all. Think about it, a hot new fashion trend, a cool new restaurant idea. It can be copied in a flash, and that makes them, frankly, pretty risky bets for the long haul. So the big question is, how do you find the ones that are actually built to last? Well, it all boils down to one really important idea.
And that idea is something called an economic moat. Just picture a castle, right? The moat is that big ditch of water all around it. It's the defense system. For a company, the moat is what protects it from invaders, which of course are its competitors. Now, this defense could be a super strong brand or a unique patent, but in retail, and this is key, it's almost always about having a massive cost advantage. The wider that moat, the safer the castle's treasure. Its long-term profits really are.
So check this out. It's really all about this contrast. On one side, you've got your wide moat giants, your Walmarts and Home Depots. Their advantage? They're so huge they can buy things cheaper than anyone else and sell them for the lowest prices. And that is super, super tough to copy. Then on the other side, you have, well, pretty much everyone else. Their advantage might be a trendy product or a hot new menu item, but that kind of thing, it just doesn't last. So the real trick here, the thing we've got to learn, is how to tell the difference between the two. And to do that, we're going to look at a couple of really powerful tools.
All right, tool number one, the restaurant life cycle. Let's start with restaurants. If you really want to get a handle on a chain's potential, you can actually map out its entire journey. It's an amazing way to see not just where a company is right now, but more importantly, where it's probably going.
So basically, every single restaurant chain goes through these 4 stages. First up is speculative growth. This is when a new idea is just being tested out. It might have a lot of buzz, but it's almost definitely losing money. Now, if it makes it through that, it hits stage 2, aggressive growth. Cash flow is usually negative because every dime is being plowed back into growth. Then, if they're one of the lucky ones, they hit the slow growth stage. Expansion cools down and the focus shifts to just being profitable and efficient. And finally, well, if they lose their touch, they hit decline.
And man, this quote really hits home because this is the brutal reality of the restaurant world. Let this sink in. Most new restaurant ideas never, ever make it past that first speculative stage. They just fail. And a whole lot of the ones that do make it to that aggressive growth phase, they burn out before they can ever get to a place of stable, long-term profits. It is a ridiculously tough business.
So what's the secret sauce?
What separates the survivors from, well, everyone else? Okay, first, they've got a concept that is already proven to work. It's past that risky first stage. Second, it's an idea that travels well. You know, what's a hit in Florida has to be a hit in Ohio too. And third, and this one is absolutely crucial, they are committed to keeping things fresh. You look at a company like Darden, they remodel their Olive Gardens like clockwork, every 7 years or so. Sure, it costs a ton of money, but it's absolutely essential if you want to stick around. Okay, let's switch gears from restaurants to retail with our second tool. We're talking about retail's cash engine. Look, if you want to know how well run a retailer truly is, you've got to ignore the flashy ads and the marketing fluff. You need to look under the hood at its cash engine. There is one specific metric that just cuts through all the noise and tells you exactly how efficient a company is. It's called the cash conversion cycle.
So what is that? Well, to put it simply, this number tells you how many days it takes for a company to turn all the products on its shelves, its inventory, back into actual cash in the bank. And the rule here is simple. The lower the number of days, the better. It's a really powerful sign of just how well a company is being run.
And the formula basically tells a story in 3 parts. Part 1 is days in inventory. How long does a product sit on the shelf before it's sold? Obviously, you want that number to be low. Part 2, days in receivables. How fast do you get paid? Again, you want that to be low. But part 3, this is the secret weapon. It's called days payable outstanding. This is how long you can make your suppliers wait before you pay them. And for this one, you want that number to be as high as you can possibly get it.
All right, let's make this real with an example. Take a look at Home Depot's numbers, comparing 2001 to 2002. In just 1 year, they cut their cash conversion cycle from 37 days down to 34. Now, I know what you're thinking. 3 days? Who cares? But for a company the size of Home Depot, a 3-day improvement is massive. We're talking about freeing up billions of dollars in cash. So the question is, how on earth did they do it?
The magic trick is right here on the screen. It's all in that days payable number. See that? In 2002, Home Depot flexed its muscles. It used its massive size and negotiating power to stretch out the time it took to pay its suppliers, from 33 days all the way up to 41 days. Think about that. By just holding onto their cash for an extra 8 days, an extra week, the company boosted its cash flow like crazy without having to sell a single extra hammer. Now that is what operational efficiency looks like.
And this right here, this is the absolute holy grail of retail efficiency. Walmart is so unbelievably good at this that they sell about 70% of their stuff. They get the cash from you, the customer, before they even have to pay their suppliers for it. I mean, just let that sink in. Their suppliers are effectively giving them an interest-free loan to run their business. That is what a wide, practically unbeatable economic moat looks like in the real world.
Okay, so now we've got our tools, we know what to look for, so let's put them to work and talk about some of the big red flags, the common traps that investors fall into. Because believe me, companies can play some games with their accounting to make themselves look a whole lot healthier than they really are. You just need to know where to look.
All right, red flag number 1. Let's talk about a metric you hear thrown around all the time, same-store sales. People call it comps. Now, it's supposed to be a health check, right? It measures the sales growth only in stores that have been open for at least a year, so you're comparing apples to apples. But can this number lie to you? Oh, you bet it can.
Is something called the maturing store effect. Here's how it works. A brand new store almost never hits its peak sales in the first year. That usually happens in year 2 or 3 as it gets established. So, if a company is on a massive expansion spree, opening tons of new stores, its overall comps number can look amazing, but it's not because the business is healthy, it's because it's being artificially inflated by all these new stores hitting their stride. And that can completely mask the fact that the older, core stores are actually struggling. The second they stopped opening new stores, boom, the weakness was exposed and the stock just cratered.
Okay, on to red flag number 2, debt that's hiding in plain sight. You can look at a company's main balance sheet and it might look great, squeaky clean, not a lot of debt. But you've got to be a bit of a detective and dig into the fine print, the footnotes of the financial reports, because that is where the real debt is often lurking.
And this is a perfect example. Back in 2002, if you just glanced at Tummy Hilfiger's balance sheet, you'd see about $638 million in debt. Okay, not ideal, but it seems manageable. But if you did your homework and read the footnotes, you'd find another $273 million in what are called operating leases. That's basically just a fancy term for the rent they owed on all their stores.
So you add that in, and suddenly their real debt isn't $600 million, it's over $900 million. That's a way, way scarier number. And sure enough, when their sales started to dip, the stock got absolutely hammered.
Okay, so let's bring this all home. We've looked at the tools, we've spotted the red flags, so what does a real winner in this space, what does their anatomy actually look like? What separates the best from the rest?
You know, the truly great retailers, they are just masters of the basics. First off, their stores are clean, they're fresh, they're places you actually want to be. They create a culture where employees are focused on good service, and behind the scenes, they are just brilliant operators. They're so in tune with their customers that inventory just flies off the shelves. That's your low inventory days. They use their power to get better deals from suppliers. That's your high payable days. And when you put all of that together, you build something incredibly valuable, a brand that people know and trust.
But you know what? At the end of the day, in an industry like this where there are almost no barriers, where anyone with a decent idea can open up shop and copy a hot product, one single advantage stands head and shoulders above everything else: being the undisputed, undeniable, low-cost leader. That is the single best way to build a wide, lasting economic moat in retail. Think about it. Walmart sells stuff you can get a million other places, but they sell it for less, and that is a ridiculously powerful advantage that is just almost impossible to beat.
So here's my challenge to you. The next time you walk into any store, I want you to look around with new eyes. Look past the price tags and the sales signs. Is the place clean? Do the employees seem happy to be there? Are the shelves stocked with what people actually want, or are they full of dust collectors? You now have the tools to see these places not just as a shopper, but as an analyst. So what story are they really telling you?
Welcome to The Explainer. We're about to pull back the curtain on a huge, and I mean huge, sector that's often totally invisible: business services. We're talking about a world of quiet giants, companies you've probably never even heard of, but they are absolutely essential, running these incredibly profitable businesses that, basically power our entire economy from the shadows.
Okay, so here's our game plan. First, we're going to uncover these unseen giants. Then, we'll get into the nitty-gritty and dissect the three completely different ways they make their money. You've got code, you've got people, and you've got heavy machinery. And to wrap it all up, we'll give you a simple checklist that you can use to spot these patterns out in the wild.
So first things first, let's really pull back that curtain. Look, these aren't your household names, right? We're not talking about Apple or Nike, but they are the essential, hidden gears turning behind the scenes of pretty much every business you interact with every single day.
Yeah, it sounds a little like the start of a strange joke, doesn't it? But the answer actually connects three absolute titans of industry. You've got waste management, the payment processor Fiserv, and the payroll giant ADP. And each one represents a totally unique flavor of this incredibly diverse and, well, powerful sector.
So, what exactly is a business service? At its heart, it's a really simple but totally game-changing idea. Companies outsourcing tasks that aren't, part of their core mission. I mean, think about it. Why should a restaurant chain have to worry about running payroll? Or why should a law firm have to manage its own IT department? They don't. They hire specialists to do it for them, which frees them up to focus on what they actually do best.
And this, right here, this is the key. It's the engine driving the whole sector's growth, this unstoppable trend of outsourcing. More and more, companies are realizing it's just smarter. It's cheaper to let an expert handle things like HR, or IT support, or even cleaning services.
And look, this isn't just some vague idea or a hunch. The economic data is just, well, it's stark. Take a look at this chart. As a percentage of the entire U.S. economy, these B2B services just exploded in about a decade. That's not just growth, people. That's a fundamental shift in how business gets done.
So, what's the logic behind all this? Well, this quote really just nails it. It's about saving time and money, of course, but the real prize? It's focus. It lets a company's management stop worrying about, the plumbing and instead concentrate all their energy on what really matters, winning their market.
All right, let's dive into our first model. And honestly, it's a real beauty, the tech-based model. This is where companies literally build their empires on a foundation of code and lots of cash flow.
So this is what I like to call the build it once, sell it a million times model. Just think of companies like ADP or Fiserv. They spend an absolute fortune creating this complex, powerful software platform. But then they can sell access to that exact same platform to thousands and thousands of clients with practically zero extra effort.
And this is where the magic really happens.
Look at this process here. Step 1, yeah, it's painful. You have this massive upfront cost to build the system. But then comes the payoff. For every single new client they sign, the cost to serve them is tiny, just a little bit. And that means each new dollar of revenue is almost pure profit. That's a powerful concept called operating leverage, and it is exactly how these companies become just unbelievable cash-generating machines.
So this right here is basically the perfect blueprint for what makes a fantastic tech-based business. You want to look for companies that are just gushing free cash flow because their ongoing costs are so low. They've got predictable, recurring revenue, usually from long-term contracts, and maybe best of all, they often have this massive, untapped market to grow into for years and years.
Okay, on to our second model. And this one, well, it couldn't be more different. We're shifting gears completely, from a world of code and servers to one that is built entirely on people, on their skills, and what we call spreads.
In this model, the company's most important asset literally walks out the door every single evening. It's their skilled employees. We're talking about consulting firms, staffing agencies, that sort of thing. Their entire business is built on that spread, which is just the gap between what they pay an employee and the much, much higher rate they charge a client for that person's time and expertise.
And this slide really just puts the core difference in stark relief. See, the tech model can scale almost infinitely, just by adding more users to a system that's already built. But the people model, it can only scale by hiring another person. And that's absolutely critical, because it means their competitive advantages, what we call their moats, are often a whole lot easier for a rival to come in and attack.
So the question is, how do you win in a people-based business? It's a totally different game. You absolutely have to stand out from the crowd, kind of like how Robert Half focuses only on professional staffing. You need to provide a service that's just necessary, something people can't do without, like credit ratings from Moody's. And maybe most importantly, since your product is actually people, building those unbreakable client relationships, well, that's everything.
Okay, time to move on to our final model. And this is where success isn't built on code, it's not built on people, it's built on heavy metal, massive machines, and huge physical networks.
Yeah, welcome to the world of hard assets. We're talking about companies like airlines, waste management, or FedEx. For these guys, growth is incredibly expensive. You can't just add another line of code. If you want more business, you have to physically go out and buy another multi-million-dollar plane, or another truck, or even get a permit for a new landfill.
And let me tell you, this model can be an absolute meat grinder. The poster child for how tough this business is? The airline industry. It's a classic hard asset business that, as a whole industry, lost a mind-boggling 11 times billion dollars over just 2 decades. And why is that? Well, the costs to operate are massive, but all the customers care about is finding the cheapest ticket, and that leads to these just brutal, non-stop price wars.
And the result of all those losses? A corporate graveyard. Seriously. During that exact same period, 125 U.S. airlines filed for bankruptcy. It is such a powerful lesson. In this game, if you don't have a truly unique, defensible competitive advantage, your margin for error is basically zero.
But wait, that doesn't mean it's impossible to win here. There is one shining exception to the rule: Southwest Airlines. I mean, they pulled off something astonishing: 30 consecutive years of profits in that absolutely brutal market. So how'd they do it? By being totally relentless about one thing: being the lowest cost operator, period. That meant one type of plane, no fancy meals, no complicated hub and spoke system. Just simple, cheap, and effective.
So here's the crucial takeaway for any hard asset business. There are really only 2 ways to win. Path number 1, be the undisputed, hands-down, low-cost leader, just like Southwest. Path number 2, own a unique asset that nobody else can copy, like Waste Management's network of landfills. That's it. It's either be the cheapest or own something completely irreplaceable.
Okay, so we've broken down the 3 core playbooks, right? You've got tech, people, and hard assets. Now let's tie it all together with a really simple checklist you can use to analyze pretty much any company in this entire sector. Think of this as your framework, your mental model for how to look at these businesses. First, and this is the most important part, you have to identify which of the 3 models you're using. Is it tech, people, or hard asset? Then you go on the hunt for the signs of a great business. Does it have scale? Is its revenue predictable? Is it generating a ton of cash? And finally, you have to look to the future. How big is the opportunity really, and are the company's plans for growth actually realistic?
So, we'll leave you with this one question to think about. Now that you know these 3 patterns, the tech model, the people model, and the hard asset model, start looking for them. Just look around.
You'll start to see that they are hidden in plain sight all around you, these invisible engines that are powering our world. Thanks for tuning in to The Explainer.
Have you ever really stopped to think about what a bank is? I mean, they're on every corner, but for most of us, they're kind of a black box. The truth is, banks are the engine that keeps our whole economy running. Seriously, without them, things like buying a house or starting a business would be next to impossible. So today, we're going to pry open that black box and see exactly how this engine works. You ready? Let's get into it. This quote from J. Paul Getty, it just nails it. It gets right to the very heart of banking. See, it's a business that's built entirely on these huge concepts of risk and scale and managing just staggering amounts of money. The biggest question is always, who's holding the risk and how is it being managed? That single question pretty much defines everything a bank does. All right, so here's our game plan. First, we'll look at the core model, which is actually way simpler than you might think. Then we're diving deep into the risks that are the absolute center of the business. We'll check out what makes some banks so powerful, how you can spot a solid one, and we'll wrap it all up with a handy checklist you can use to make sense of any bank. Okay, let's kick things off with the absolute basics. You know, for all the complexity and jargon we hear about, the fundamental way a bank makes money is incredibly straightforward. It all boils down to one simple idea: borrow low and lend high. That's it. And this is where the magic happens. It's called net interest income. Think about it. When you put your money in a savings account, the bank pays you a little bit of interest, right? Then they take that same money and lend it out to someone else for a mortgage or a car loan, but at a much higher interest rate. That difference, that gap between what they pay out and what they bring in, that's the spread. And that's their profit. So to put it in super simple numbers, if a bank pulls in, say, $1,000 from loan interest and it pays out $500 to people with savings accounts, that $500 difference is its net interest income. That right there is the heart of their revenue. So you're probably thinking, if the model is that simple, why is banking so complicated? Well, the answer is one word: risk. The whole business, everything they do, is built on managing risk, not just for themselves, but for all of us, for the whole economy. Let's break down what that really means. A bank basically gets paid to be an expert at handling three very specific kinds of risk. First up, you've got credit risk. The big question: will they get their money back? Then there's liquidity risk. Can they actually give you your money when you ask for it? And third, interest rate risk. What happens if the market goes haywire? Let's start with the big one, credit risk. This is the most basic risk in lending. It's the simple, and let's be honest, kind of terrifying possibility that the people who borrowed money just won't pay it back. Getting this right is everything. So how do they defend against that? Well, banks have three main shields. First is portfolio diversity. You spread the loans out across tons of different people and industries, so if one part of the economy goes south, it doesn't sink the whole ship. Second, conservative underwriting. That's just the fancy term for doing their homework and making sure someone can actually afford to repay a loan. And third, if a loan does go bad, they have aggressive collections to try and get back whatever they can. Next up is liquidity risk. Now, this is interesting. Banks take our money, which we can ask for at any time, right? And they turn it into long-term stuff, like a 30-year mortgage. So what happens if a whole bunch of us show up on the same day wanting our cash? A bank has to have enough cash on hand to handle that. It's a constant, delicate balancing act. And finally, there's interest rate risk. This one's a huge deal because a lot of it is completely out of the bank's control. Imagine interest rates in the market suddenly shoot up. Well, the bank has to start paying more interest on its savings accounts right away. But the money it's making from all those old fixed-rate mortgages, that stays the same. That mismatch can crush that profitable spread we were just talking about. Okay, so if banking is all about wrangling these different risks, what separates a decent bank from a truly dominant one? Well, investors have a cool term for it. They call it a competitive moat. It's basically a set of advantages that makes it almost impossible for a new guy to come in and compete. These moats are built from a few key things. First, you need a massive balance sheet. We're talking trillions of dollars to even play in the big leagues. That size leads to huge economies of scale, meaning it's just cheaper for big banks to operate. And finally, there's us, the customer. Let's be real. Switching banks is a pain, so we tend to just stay put. And here is where you can really see the power of being big. Back in 2002, the giant banks were generating more than double the revenue for every single employee compared to the small local banks. This isn't just about being efficient. That kind of scale lets them borrow money cheaper, pour billions into tech and security that small banks can't afford, and offer way more products. It's a massive advantage that just keeps getting bigger. And here's that customer stickiness in action. About 85% of a bank's customers will still be customers the very next year. I mean, think about yourself. Changing your bank account is a nightmare, right? You gotta move your direct deposit, update all your auto pays. Who has time for that? Most of us just don't bother. And that gives banks an incredibly stable and cheap source of money.
Okay, so how can we, from the outside, figure out if a bank is actually strong and well managed? It all starts with understanding one of the most powerful and most dangerous tools in all of finance: leverage. The key number to look at is the leverage ratio. It's just a bank's total assets divided by its own money, its equity. Now, for a normal company, this ratio might be, 2 or 3 to 1. For the average bank, it's around 12 to 1. That means for every single dollar of its own capital, it's controlling $12 in assets. It's nuts. I know that sounds a little abstract, so let's make it super real. Let's say you go buy a house for $100,000, but you only put $8,000 of your own money down. The rest, you borrow from the bank. In that situation, your personal leverage is $100,000 divided by $8,000, which comes out to 12.5 to 1. Hey, look at that. It's pretty much the exact same leverage as the average bank. You're controlling a huge asset with just a tiny sliver of your own cash. Now, here's where it gets scary. See, leverage is awesome when things go up, but it's brutal when they go down. So what happens if the market takes a dip and the value of your house falls by just 10%? It's now only worth $90,000. The result? It's a total disaster. You still owe the bank $92,000, but your house is only worth $90,000. Your entire $8,000 down payment, all of your equity is just gone, wiped out. A tiny 10% drop in the asset's value caused a 100% loss of your money. That is the terrifying power of leverage, and it's the tightrope that every single bank is walking every single day. So knowing that danger, how do we find the strong banks? Well, analysts look at 3 key numbers. First is return on equity, or ROE. That tells you how much profit the bank is making with its shareholders' money. A consistent 15 to 20% is a really good sign. Second is return on assets, or ROA. This shows how well the bank uses all its money to make a profit. The best ones are in the 1.2 to 1.4% range. And finally, the efficiency ratio. This is like a bank's golf score. Lower is better. It shows how much it costs them to make $1 of revenue. Phew, we have covered a ton of ground. So let's pull all this together into a final takeaway toolkit. Think of this as your personal checklist for really understanding any bank you might be looking at. So here it is, your final checklist. First and most importantly, never forget those 3 faces of risk. Is the bank managing its credit, liquidity, and interest rate risks carefully? That's job number 1. Second, look for real strength in the books. You want a bank run conservatively with a big equity cushion to handle shocks and a history of steady profit growth, not just wild ups and downs. And third, make sure the business model is solid. Do they have a real competitive moat? Are their loans and deposits properly matched up? If you can answer those questions, you're well on your way.
And all of this brings us to one final big question. The very same leverage that allows banks to be the engine of our economy, to fuel our homes and businesses, is the same thing that makes the whole system so fragile in a crisis. This double-edged sword is the central tension of all of modern finance. So is this incredible power a fuel for growth, or is it a fire, just waiting for a spark? Something to think about.
So, you'd think that 2 industries built on the exact same idea, managing other people's money, would be pretty similar, right? Well, you'd be wrong. They are polar opposites. I mean, on one side, you've got a business that is basically a license to print money. And on the other, a brutal, competitive grind where just surviving is a huge win. Today, we're going to peel back the layers on asset management and insurance to figure out what makes one a profit machine and the other a constant battle.
And this contrast, it really sets the stage for everything we're going to talk about. The thing about asset management is that its economics are so powerful, so good, that even a pretty average company can look like a total superstar. But insurance? Totally different story. And why is that? Well, because insurance, at its core, is a commodity. Think about it. When you're shopping for car insurance, what do? You look for the best price. And that forces all these companies into this constant, brutal, margin-crushing price war.
All right, so here's the game plan for today. First up, we're diving into the beautiful mechanics of the profit machine. Then, we'll tackle the high-wire act that is life insurance, which we're calling a complex bet. After that, we'll see how P&C insurers handle their crazy boom and bust world in surviving the cycles. And finally, we'll wrap it all up with the investor's checklist. Basically, what you need to look for in a great company in any of these fields.
Okay, let's get right into it. Part 1, the profit machine. We're deconstructing the incredible business model of asset management.
You know, this quote just absolutely nails it. The business model is, well, it's brilliantly simple. You get people to give you their money to manage, and then you just charge them a tiny percentage of that total, year after year. It doesn't even matter if the market is up or down. As long as you have their money, that fee income just keeps rolling in. It's like a constant flowing river of cash.
And that river of fees, it leads to some truly staggering results. I mean, just take a second and really look at this number. 30 to 40% operating margins. Let's put that in perspective. For every single dollar that comes in the door, 30 to 40 cents can become pure pre-tax profit. You know, in most other industries, a 10% margin is considered pretty healthy. 20%? That's amazing. These numbers, they're just in a completely different league. And it's all because the business requires almost no physical stuff. No factories, no inventory to grow.
So, what's the secret sauce here? It's the magic of scale. Let me walk you through it. It's super simple. Step 1, you attract a bunch of client money, what they call assets under management, or AUM. Step 2, you charge your little fee on all that AUM. Now, here comes the magic part. Step 3, your costs don't really go up that much. I mean, your main cost is just salaries for your team, right? And the same team that manages $1 billion can pretty much manage $2 billion or even more. And the result of all that? Step 4, profits just explode. They grow way, way faster than your costs.
Okay, so how do the best companies protect these incredible profits? Well, they build a massive economic moat around their business. Think of it like a castle wall. They do it in two main ways. First, diversification. They basically become a financial supermarket. They offer everything: aggressive stock funds, super safe bonds, you name it. That way, they have something to sell no matter what the market is doing. And second, they go after what's called sticky assets. And this is the holy grail. We're talking about money from huge institutions, pension funds, retirement accounts. The kind of money that's in it for the long haul and isn't going to run for the hills the second the market gets a little shaky.
I love this analogy because it's just so perfect. It shows you exactly why that diversification is so crucial for survival. I mean, imagine a bear market where stocks are just getting hammered. Trying to sell a stock fund then? Yeah, it's like trying to sell popsicles at the North Pole. It's just not going to happen. But if you can offer those same clients a place to warm up, say a stable bond fund or a safe money market account, you keep their business, you keep their money in a house, and it's all ready to go when the market eventually thaws out.
Okay, now there's this quiet, often overlooked cousin to asset management. It's called custody services. And this Tonto and Lone Ranger analogy, it's just perfect. The asset manager gets all the glory, right? They're the Lone Ranger, making the big calls. But the custodian, they're Tonto, the indispensable sidekick doing all the essential but kind of boring work behind the scenes. We're talking settling trades, collecting dividends, keeping track of trillions of dollars in assets. It's not as high margin, for sure, but man is it stable. It's a business built on massive scale, and it's incredibly predictable.
All right, so we've seen the beautiful, beautiful simplicity of the profit machine. Now let's completely flip the coin and look at a business that is anything but simple. This isn't about predictable fees. No, this is about making a promise today based on a future you can only guess at. So welcome to the complex, high-stakes bet that is life insurance.
And hey, if you need any proof of just how tough this business is, look no further than this chart right here. I mean, this isn't just a small gap in performance. This is a chasm, an ocean. Over a decade, the Life and Health Index returned just 3.6% a year. That barely even keeps up with inflation. Meanwhile, the S&P 500 delivered over 10%. This chart tells a very clear story of a business model that is fundamentally challenging. And now we're going to dig into why.
Okay, here it is. This is the absolute heart of the problem. This is what makes it so hard. Imagine you're running a bakery. You have to decide the price for a loaf of bread today, but you won't actually know how much the flour costs you for another 20 years. How could you possibly run a business like that? Well, that is exactly what life insurance is. They sell a policy, a promise, based on all these complex guesses about how long people will live and what the market will do. But the final report card on whether they got that price right, it might not show up for decades.
And that long-term uncertainty, it creates an incredibly thin margin for error. Let's break this down because it's super important. Think of cost of equity as the minimum grade you need to pass a class. It's what investors expect just for taking on the risk. Return on equity, or ROE, is the actual grade the company gets. And for the average life insurer, their grade, around 12%, is just barely scraping by. They're getting a C- when passing as a D. There's basically zero room to get those decades-long predictions wrong.
Okay, so if life insurance is one big, long-term bet on when people will die, our final category is totally different. This is property and casualty insurance. And it's more like a series of short-term gambles on, well, on everything else. Catastrophes, car accidents, bad decisions. This is your auto, home, and business insurance. And this whole world is defined by these absolutely punishing cycles.
But these P&C guys, they have a secret weapon. And it's an advantage so powerful that it's been the engine behind Warren Buffett's entire empire. It's called float, and it's pretty genius. Here's how it works. You pay your car insurance premium today, right? But you might not get in an accident for months or even years. So in the meantime, the insurance company gets to take your money and everyone else's money and invest it for their own profit. It's better than an interest-free loan. If you do it right, it's literally a giant pile of free money that you get paid to invest. But of course, there's a catch. There's always a catch, right? P&C insurers face the exact same puzzle as the life insurers, just on a much shorter timeline. So how on earth do you set a price for car insurance today when you have no idea what a new bumper will cost next year, or what medical bills will look like, or, and this is the big one, what some jury might decide to award in a lawsuit 2 years from now? That last piece, they call it social inflation, and it's a huge, wild variable that's almost impossible to predict. So to figure out if they're actually winning this crazy pricing game, we look at one number above all else, the combined ratio. Now don't get bogged down in the details. The only thing you really need to remember is this. It's like golf. The lower the score, the better. Is the number under 100? Great. If it's a 98, that means for every dollar they took in, they only paid out 98 cents. They made a 2% profit just from selling insurance. That's called an underwriting profit. But if that number is over 100, well, they lost money on their main business. And they're just praying that the money they made investing their float can bail them out. And this whole dynamic creates the infamous insurance cycle. It's a total roller coaster. It starts with what they call a soft market. Times are good, everyone's making money on their investments, and they all get greedy. They start cutting prices like crazy to steal customers from each other. And those combined ratios start creeping up over 100. Then, bam, disaster strikes. A massive hurricane hits or the stock market crashes. Suddenly, all these insurers are bleeding cash. So what do? To survive, they have to jack up their prices big time. Competition disappears, and the industry enters a hard market. Profits are restored until, of course, everyone gets greedy again and the whole cycle starts all over.
All right, so we've navigated the profit machine, we've dissected the complex bet, and we've ridden the ruthless cycle. You might be thinking it's impossible to find a consistent winner in any of these businesses. But here's the thing. The truly great companies, they leave clues. And that brings us to our final and most practical section, the investor's checklist. First up, asset management. What you're looking for here are signs of a deep, wide moat. So ask yourself, do they have products for any kind of market, or are they just a one-trick pony? Who are their clients? Are they those sticky, loyal institutions we talked about, or are they flighty individuals who will run at the first sign of trouble? And maybe most importantly, are they huge? Do they have massive scale? Because in this game, the big just keep getting bigger, and being the market leader is a massive, self-reinforcing advantage. Now, for life insurers, the name of the game is caution and discipline. So you're not just looking for good signs, you're looking for red flags. Ask yourself, is this company growing way too fast? That's a huge warning sign they might be taking on sketchy risks to get new customers. How's their report card? Is their ROE consistently higher than their cost of equity, or are they just barely passing? And take a look under the hood at their investments. Does it look like a fortress built on high-quality bonds, or is it a house of cards built on risky junk?
And finally, in the cutthroat world of P&C insurance, there are really a few proven ways to win. Path 1, you can be the low-cost leader, think Geico, who completely changed the game by cutting out the agents. Path 2, you can be the smartest specialist in the room. Think of a company like Markel that makes a fortune insuring weird stuff that nobody else even understands. But no matter which path they take, there are two non-negotiables. You have to see a rock-solid, fortress-like balance sheet, and you need a management team that thinks and acts like they own the place. People who have the discipline to say no to dumb growth when the market gets soft.
And that brings us to the end. We've looked at three totally distinct business models. First, the asset management profit machine, built on that beautiful magic of scale and recurring fees. Then, the complex bet of life insurance, a business that's constantly balancing on a razor's edge of long-term guesses. And finally, the P&C survival cycle, where discipline is literally the only thing that matters. Each one has its own path to success and its own hidden landmines. So I'll leave you with one final question to think about. Knowing everything you know now, which business would you put your money on?
Welcome to The Explainer. Today, we're jumping into the world of software. You know, it powers pretty much everything we do. But from an investor's point of view, it's got this totally unique economic setup that you just don't see in other industries. So what's the secret sauce? What makes it so powerful and so profitable? Well, let's dig in and find out.
So let's kick things off with a number that should really make you sit up and pay attention. 40%. And that's not all. It can be even higher. When a software company creates a hit product, a real winner, it can pull in operating margins of over 40%. That's an absolutely incredible number, and it's exactly why we need to get under the hood of this industry. It's a world of huge upfront costs, for sure, but the potential for massive, scalable profits on the other side is just unreal.
So, to get to the bottom of it all, we've broken down our little expedition into 6 key parts. First, we'll look at the software gold rush to really understand the unique money-making machine here. Then, we're going to map out the entire industry landscape. After that, we'll see how the winners build their defenses, their moats, and then we'll learn how to read the secret signals of a company's financial health. And finally, we'll cover the big red flags every investor should watch out for and wrap it all up with the blueprint for what real success looks like.
Okay, part 1, the software gold rush. So why the gold rush? Well, the basic idea behind software economics is actually brilliantly simple. Think about it. The cost to create that very first copy of a program is enormous. You've got teams of developers, all the testing, the marketing, it costs a fortune. But, and this is the magic part, the cost to produce every single copy after that first one, it's practically zero. You just deliver it over the internet. And that creates this incredible engine for profit.
And this is exactly why that simple principle turns a successful software company into an absolute cash cow. I mean, look at this. They don't need warehouses for inventory. It's all digital. They don't have to wait long for payments because shipping is instant. And they don't need a ton of capital to churn out more products. This whole combination means they can just generate tons and tons of free cash flow, all while tapping into amazing growth as every business on the planet looks for software to get more efficient. All right, on to our second section, mapping the landscape. You see, the software world isn't just one big blob. It's broken up into these distinct territories. And here's the thing you'll see over and over. Most of these territories are oligopolies. That just means a handful of big companies control almost all the sales. And why does that happen? Because the people buying the technology are usually pretty conservative. They want to buy from a leader, someone they know is going to be around in a few years to offer support.
And if you look at this map, you'll see exactly what I mean. In operating systems, you have the 800-pound gorilla, Microsoft, and some specialists like Red Hat. When you look at databases, it's a fight between Oracle, IBM, and Microsoft. For those big, complex back-office systems, that's ERP, it's pretty much SAP and Oracle. And it's the same story with CRM, security, even video games. You see the same pattern again and again and again. A few dominant players owning each territory.
Okay, Section 3. So we've seen the map of these territories. But how do the winners defend their turf? Honestly, this might be the single most important question for anyone looking to invest in this space. It's all about building a real, sustainable competitive advantage, or what investors like to call an economic moat. It's a defense that can actually outlast the next big thing in technology.
And here's the crucial point. An economic moat isn't just a temporary edge. It's a durable advantage that keeps competitors out and protects your profits for the long haul. But man, in the software world, this is incredibly hard to do. It doesn't cost much to start a software company, and technology moves so fast that today's hot new thing can become yesterday's news in a heartbeat. So a real moat, a lasting one, has to be about way more than just having the best tech right now.
So if it's not just about having the coolest technology, what is it about? Well, the most powerful, long-lasting moats in the software business usually fall into one of these 3 buckets. First, you make it super painful or expensive for your customers to leave you for a competitor. That's high switching costs. Second, you build a network effect where your product actually gets more valuable the more people use it. And third, you build a brand so strong it becomes the default choice.
You know, this quote just hits the nail on the head. Technology is fleeting.
it changes. A durable competitive advantage, that doesn't. The real winners, the ones that last for decades, find a way to lock in their success that goes so much deeper than just a clever piece of code or a pretty interface.
Let's make this real. On the left, you've got a temporary edge, a more innovative product. Great, but that can be copied or one-upped pretty quickly. Now look at the right side. That's a real moat. Think about Autodesk. Architects and engineers spend years training on their software. They're locked in. That's a huge switching cost. Or think about Adobe's PDF. Its value exploded because everyone started using it, making it the standard. That's a classic network effect. And what about Intuit? For small businesses, QuickBooks is just what you use for accounting. That's pure brand power. See, these are the advantages that really last.
Okay, let's move on to part 4. Now we're going to peek behind the curtain a little bit. The good news is that software companies tend to have pretty clean financial statements. But there are a few special terms, a little bit of jargon, that can tell you a ton about the real health of the business, if you know where to look.
First up is something called license revenue. This is simply the money a company makes from selling new copies of its software. This line item is your best signal for current demand. Is the product still hot? Are new customers piling in? Because this revenue is so ridiculously profitable, a rising trend here is a fantastic sign. But if you see it start to decline, that's a major warning that growth could be hitting a wall.
Next up, deferred revenue. Now, on the balance sheet, this is technically listed as a liability. And that sounds bad, right? But trust me, in this case, it's a good liability. All it is cash the company has already been paid for services it's going to deliver later on, like maintenance or support contracts. So if you see a company's deferred revenue balance growing, that's telling you they have a really healthy pipeline of future business that's already in the bag.
And finally, we have Days Sales Outstanding, or DSO. This just measures how long it takes a company to get paid. And with this number, the trend is everything. If you see DSO starting to creep up, that can be a huge red flag. It might mean the company is getting desperate to close deals, offering easy credit terms just to hit their quarterly sales target. What they're really doing is stealing sales from the future to make today look good. And often, this is the very first sign that a product is starting to lose its edge.
And that brings us perfectly to Section 5, Investor Red Flags. Because that pressure to hit the quarterly numbers is so intense in this industry, some companies, well, they resort to some shady accounting tricks. Let's go over how you can spot some of the most common traps.
One of the real classics is a trick called channel stuffing. It's exactly what happened a while back with a company called RSA Security. Here's how it works. The company ships way more software to its distributors than those distributors could ever possibly sell in one quarter. But, and here's the trick, they book all of that as revenue right away. It makes the current quarter's numbers look absolutely amazing, but it's a total house of cards. All they've done is pulled sales forward from the future, and that always leads to a huge sales disaster down the road.
And there are other funny deals you should keep an eye out for. Be a little suspicious if you see a company selling its product to another firm, while at the same time investing a chunk of cash in that very same firm. Or these so-called swap deals where two software companies basically just agree to buy each other's stuff to create the illusion of sales. Now, some of these deals might be technically legal, but these kinds of back-scratching arrangements give a totally false picture of how much real organic demand there is for a company's product. Okay, let's put this all together in our final section, the blueprint for success. We've navigated the economics, we've looked at the moats, we've spotted the red flags. So what are the good things? What are the positive hallmarks we should be actively looking for in a truly top-tier software company? Well, here they are, the 5 signs that separate the good from the truly great. It starts with consistent sales growth. You want to see more than 10% a year. But that's not enough. You also want a long track record, proof that this company has survived and thrived through good times and bad, not just one lucky product cycle. And as they get bigger, you absolutely want to see their profit margins expanding. That shows they're really cashing in on those economies of scale. All of this is built on a huge loyal base of customers who keep coming back for more. And number 5, and this is so important, great management. In the software business, the people, the engineers, the visionaries, they are, without a doubt, the most important asset.
So let's just boil our whole journey down to one final cheat sheet. On the left side, these are the green flags, the things you want to see. Durable moats, rising license and deferred revenue, and of course, buying at a reasonable price. And on the right, the red flags you got to be wary of. Don't get seduced by cool tech alone, watch that rising DSO like a hawk, and be really careful about those sky-high valuations.
And that leaves us with one final question to chew on.
In an industry that is defined by constant, relentless change, what is a software company's truly strongest asset? Is it the elegance of its code, which, let's be honest, can always be copied or improved upon? Or is it the loyalty of its customers, who are locked in so tightly that they're not going anywhere? It's something to think about.
You know that feeling, right? You get some brand new piece of tech, you're super excited, and then, almost instantly, it feels like it's already old news. Well, in this explainer, we're going to dig into the wild world of the hardware industry to figure out the big question. If the tech is always getting better, why do so many of these companies go bust? And how do the real winners, the ones that stick around, actually pull it off?
Oh yeah, it's the classic story. You spend your hard-earned cash on a new computer, you feel like you're on top of the world, and then, boom. A month later, there's a new one out that's way faster and somehow even cheaper. It's frustrating for us, for sure, but that constant, relentless churn, that's not just a bug, it's the defining feature and the biggest challenge of the entire hardware business.
Okay, so let's get right into it. This whole cycle creates something we can call the hardware paradox. And it's this fundamental tug of war between what's amazing for us as customers and what makes running a hardware company just incredibly, incredibly tough.
Yeah, I mean, you can see the two sides of the coin right here. For us, it's a party, right? Our gadgets get ridiculously powerful and the prices keep dropping. But flip it around, and for the companies making this stuff, that exact same reality creates this brutal, cutthroat world where profits just seem to evaporate. Almost all that incredible value from innovation, it goes straight to us, the consumer, not the company that created it.
So what's the engine driving this whole crazy train? Well, it's a little something you've probably heard of called Moore's Law. It was first pointed out by Intel's co-founder, Gordon Moore, way back in '65, and it's a pretty simple idea. The power of a computer chip basically doubles every 2 years or so. That insane pace is the reason we're all stuck in this constant faster, cheaper, better loop. And here's what that looks like in the real world. That gray line is your typical business investment. It goes up, it goes down, pretty steady. But that black line, that's hardware spending. It's a total roller coaster. You see these massive peaks followed by these gut-wrenching drops. When the economy's booming, companies throw money at IT. But the second things get tight, it's the very first budget to get slashed. It makes the whole industry just wildly unstable. All right, so this instability and competition leads us to something called the technology trap. And this is where we need to tear apart one of the biggest myths out there. The idea that just having the best, the fastest, the most amazing technology automatically means you're going to win. This right here, this is the key. Technology by itself does not constitute a sustainable competitive advantage. You have to let that sink in. It's the core reason why so many hardware companies with brilliant ideas just flame out. Having a cool piece of tech is great, but that lead is usually temporary. Someone else can copy it or make it cheaper, and suddenly your big advantage is gone. And if you want proof, just look at this list. I mean, do these names even ring a bell anymore? Commodore, Packard Bell. These were the titans of their day, household names. But now, they're basically the one-hit wonders of the tech world. They had a moment in the sun, a great product, and then they just got washed away by the next wave. They had the tech, but it just wasn't enough. And look, this trap doesn't just catch the little guys. We're talking about the absolute giants of the industry. IBM, the company that basically created the PC market. Even they and Texas Instruments couldn't make it work long term. They had to either sell off their PC divisions or just get out of the game entirely. It proves nobody is safe. Being first or even being the inventor doesn't mean you'll be the one left standing. Okay, so if having the best tech isn't the answer, then what is? Well, that brings us to the real solution. It's this idea of building an economic moat. This is the secret sauce. This is what separates the flashes in the pan from the companies that last for decades in this tough, tough business. The idea is actually pretty simple, but it is so powerful. Think of an old castle. What protected it? A big, wide moat filled with water. An economic moat is the exact same thing for a business. It's some kind of structural advantage that keeps competitors at bay. It's not about having the fastest chip this one time. It's about building a business that's fundamentally hard for anyone else to attack. And here's the really cool part. These moats aren't some kind of mysterious secret thing. They actually come in a few distinct flavors. So we're going to break down the 4 main types of moats that the most successful hardware companies have used to build their empires. All right, let's jump into the first one, being the low-cost producer.
And let's be clear, this is not about just having a sale or being a little bit cheaper. This is about your entire business being built from the ground up to operate at a lower cost than anybody else. Period. And the absolute textbook case for this is Dell. I mean, just look at this cycle. It is pure genius. Instead of building a ton of computers and hoping they sell, Dell got you to pay for your PC first. Then, and this is the killer part, they used your money to pay their suppliers for the parts to build it. They had almost no inventory collecting dust, and their cash flow was amazing. They weren't just a little cheaper, their whole business model was fundamentally more efficient. Now that is a serious moat.
Okay, let's talk about moat number 2. And this one is all about making it a huge, expensive, risky pain for your customers to ever switch to a competitor. In other words, creating high switching costs.
For a perfect example, just think about a massive telecom company. Their networks are unbelievably huge and complicated, built up piece by piece over decades. So when they need to buy new gear, it's not about who's cheapest. That new piece of equipment has to integrate perfectly with all the old stuff. What's the risk if it doesn't work? Catastrophe, a total network outage. So they stick with the suppliers they already know and trust. The cost of switching is just way too high.
All right, our third type of moat is a little different. It's not about your process or your customers being locked in. It's about things you can't really touch, your intangible assets. We're talking patents, brand recognition, and maybe the most powerful of all, unique, specialized knowledge.
A great example of this comes from the world of analog chips, from companies like Linear and Maxim. Now, these aren't the normal digital chips in your computer. They handle real-world things like sound, temperature, pressure. And designing them is apparently more of an art than a science. It takes this really rare, almost quirky kind of engineering talent. And that deep well of knowledge built up over years and years. Well, you can't just go out and buy that overnight. It's an asset no competitor can easily copy.
And that brings us to our fourth and final moat. And honestly, this one might be the most powerful of them all. It's called the network effect. And it's that magical thing that happens when a product gets more and more valuable, the more people use it.
The poster child for this is Cisco. Back in the day, their routers basically became the standard for the internet. And because they were the standard, every other piece of networking gear had to be compatible with them. But here's the real genius move. They created a whole system of certifications. So you had this huge army of network engineers who were trained specifically on Cisco gear. So when it was time for their company to buy new equipment, what do you think they recommended? The stuff they already knew inside and out. It's a beautiful, self-reinforcing cycle. Okay, so we've been through the paradox, the tech trap, and the 4 moats that are the way out. So let's wrap this all up. Let's turn all this theory into something practical. How do you spot a company that's actually built one of these winning moats? What are the telltale signs? Here's what you want to look for. First, they have a durable market share. They don't just have one good year. They are constantly fighting off competitors and holding their ground. Second, they have a laser-like focus. They know what they're good at and they stick to it. They don't get distracted by shiny objects. And third, they have flexible economics. They're built to survive the industry's crazy ups and downs, often by outsourcing manufacturing so they don't have a ton of fixed costs. And that really brings us to the final takeaway. The next time you see some big, flashy launch for the next big thing in hardware, the first question that pops into your head probably shouldn't be about the specs or the speed. The real question, the one that tells you if this company has a real shot at lasting, isn't just what's the tech? It's, yeah, but what's the moat?
So, you want to invest in media? What's the first thing that pops into your head? Is it big movie studios? Maybe those chart-topping musicians? Well, here's the thing. It turns out that for long-term investors, that's often the exact opposite of the right way to think. So let's dive in and figure out how to really look at the media sector like a pro.
And that really brings us to the big question here, right? How do you spot a truly great media investment? You know, the kind that's going to consistently grow and just churn out cash for years and years. It's a huge sector, and believe me, there are a lot of moving parts.
Okay, so right off the bat, let me give you the biggest hint. It has absolutely nothing to do with trying to predict the next hit TV show or that next blockbuster movie or a best-selling book. That's a super common trap that people fall into, and we're going to see exactly why it's such a bad idea.
All right, so here's our game plan. We're going to start by following the money to see how these companies actually work. Then we'll get into this awesome concept of building an economic moat. After that, we'll do a deep dive into the different industries, and that's where we'll really bust that blockbuster myth. Finally, we'll wrap up with a practical investor's checklist and a look beyond all the hype.
Okay, let's kick things off. First up, follow the money. Look, to understand any business, you got to know how it gets paid, right? And in the media world, it almost always boils down to one of three main ways they make their cash.
So what are those three models? Well, you've got user fees. That's when you pay for one thing at a time, like a movie ticket. Then there are subscriptions, where you're paying for ongoing access. And finally, advertising, which is pretty self-explanatory. Other companies pay to get their message in front of you. And trust me, understanding the good and the bad of each of these is the key to this whole thing.
So let's start with user fees. This is your classic model for movies, books, music. You get the idea. Now, the huge upside, if you manage to string together a few big hits, it can be an absolute bonanza of profits. But, and this is a big but, it's incredibly volatile. Just a few flops can be a total disaster. And what's worse, the big-name stars, think Tom Cruise, they command these enormous fees and a cut of the profits. That leaves really, really narrow margins for the actual company.
Okay, now let's talk subscriptions. Think magazines or cable TV. What's so great about this model is how stable it is. The revenue is super predictable. And get this, you get the cash up front before you've even delivered the whole service. That makes these businesses way less sensitive when the economy takes a nosedive. The downside? Well, they often have really heavy fixed costs. And for an industry like cable, it just feels like they are constantly pouring massive amounts of cash into system upgrades. It's a never-ending cycle.
And last but not least, we've got advertising. Now, the magic here is a little concept called operating leverage. Think about it. The cost to make a TV show or write a newspaper is pretty much fixed, right? So every single new person who watches or reads adds advertising money that drops almost straight to the bottom line as pure profit. It's awesome. But the big weakness? When the economy starts to struggle, advertising is one of the very first things other businesses cut from their budgets. That makes ad revenue really, really cyclical.
All right, moving on. We know how these companies make money. But the bigger question is, how do the best ones protect those profits year in and year out? That brings us to one of my favorite concepts in all of investing, building an economic moat.
So what exactly is an economic moat? Well, think of it like the moat around a castle. It's a durable, competitive advantage. It's something that makes it super, super difficult for a competitor to just waltz in and steal your business. It's this structural feature that lets a company keep making fat profits for a long, long time. And in the media industry, some of these moats are just incredibly powerful.
And in media, you tend to see three classic types of moats. First up, monopolies. Just think about your local newspaper. Most cities can only really support one, right? That gives the paper incredible power to set prices for advertisers. Second, you've got government licenses. You can't just decide to start a TV or radio station tomorrow. Nope. You need an FCC license, and there's only a limited number of those to go around. That creates a huge barrier to entry. And third, economies of scale. It costs an absolute fortune to build a big printing press, so the bigger you are, the cheaper it is to print each extra book or magazine. That gives the big players a massive cost advantage. Okay, time for our industry deep dive. We've got our tools ready, we understand the revenue models, and we know all about economic moats. So now, let's apply this framework to the three main media sectors and see which ones really look the most attractive from an investor's point of view.
And this table here just lays it all out perfectly. You've got publishing, which runs on ads and subscriptions. It has really strong moats thanks to monopolies and scale. Then you have broadcasting and cable using the same models, but their moats are a little more moderate. And then all the way at the bottom, there's entertainment. It relies almost completely on those super risky user fees, and yeah, it has the weakest moat structure of the whole bunch.
So let's dig into publishing first. Historically, this has been a fantastic place for investors to be. And why is that? Well, it's because most newspapers are basically local monopolies. If you're the only game in town, you have incredible pricing power with your advertisers. It's that simple. And companies like Gannett have used those sweet monopoly profits to expand and deliver really consistent, high returns for a long time.
Now, broadcasting and cable, that's more of a mixed bag. On one hand, the broadcasters are really well protected by those valuable FCC licenses, which keeps competition down. But the cable side of things, that's a totally different story. It has historically been a black hole for cash, just constantly needing these super expensive upgrades. And that leads to what our source calls poultry-free cash flow, which, let me tell you, is a huge red flag for any investor.
And that brings us to entertainment. Folks, this is that hit-driven trop we talked about at the beginning. The cash flow is all over the place, and like we said, the lion's share of the profits gets siphoned off by the big-name actors, directors, and execs. There's just very, very little left over for the actual shareholders in the long run. I mean, trying to consistently predict what people want to watch, it's practically impossible.
And hey, you don't have to take my word for it. Just look at the numbers. Back in the 1990s, the entertainment firms in the S&P 500, they returned only about 3% a year. Meanwhile, during that same time, publishing firms were posting average annual gains that were many, many times higher. It's just a night and day difference. Those structural differences we talked about, they lead to wildly different results for investors.
All right, let's make this practical. It's time for our investor's checklist. We've done the analysis, now let's turn this into something you can actually use. So based on everything we've just learned, what are the real, concrete signs of a great media investment?
But before we dive into the full checklist, I want to focus on the single most important number you need to look for. It all comes down to cash. The best media companies are just absolute cash machines. They are brilliant at converting their revenue into something called free cash flow. So what's the magic number? Well, the smartest investors out there look for a free cash flow margin of at least 8 to 10%. If you see that, you know you're looking at a really healthy, efficient, and profitable business.
So here it is, your media investment checklist. This is what you're looking for. First, seek out companies with those strong moats we talked about, monopolies and licenses. Second, you want to favor companies that make small, smart acquisitions, not these giant, risky mergers that blow up. Third, demand a strong balance sheet so they can grow without drowning in debt. Fourth, find a management team that's honest and that you can actually trust. And finally, insist on a high market share in whatever their main business is.
Okay, we're almost at the finish line. Let's talk about looking beyond the hype. We've covered a ton of ground today, but if you walk away with just one thing, one single rule to remember, let it be this one. This will help you avoid the single biggest trap in media investing.
And here it is, straight from the source. The number one rule is, don't chase hits. Seriously, buying a stock just because there's a lot of buzz about a hot new movie or TV show, it almost never pays off. You have to remember that one big hit is often just paying for a whole string of expensive flops that you never even heard about. The real value isn't in that fleeting spotlight. It's in the underlying structure of the business itself.
And so that leaves us with a big question to think about for the future. We've seen how incredibly powerful these moats, like local newspaper monopolies and broadcast licenses, have been in the past. But today, today we've got streaming giants and now AI completely reshaping the entire landscape. So the question is, which of these old-school competitive advantages do you think will actually hold strong, and which ones are going to crumble?
You know, the telecom industry is such a paradox, isn't it? On one hand, we absolutely cannot live without the services these companies provide. But on the other hand, for investors, it's often a minefield of frustration and, frankly, pretty mediocre returns. So what makes this essential industry such a tough place to put your money? Let's dig in and figure it out. I mean, think about it. We all have phones glued to our hands and high-speed internet in our homes. These are services we rely on every single day. So why is it that the companies providing them so often struggle to deliver real, consistent value to their shareholders? That's the big question, the central mystery we're going to unpack right now. All right, here's how we're going to tackle this. First, we'll look at the core dilemma for any telecom investor. Then we'll have to rewind the clock to see how the fall of Mab Bell created the industry we see today. After that, we'll dive into the modern, hyper-competitive battlefield, point out some common pitfalls to avoid, and finally, try to find a signal of success in all the noise. Okay, so let's kick things off with a big picture here. The telecom industry is absolutely fraught with risk. It's a sector where the rules are constantly changing, the technology is always shifting, and because of that, any potential investment you make requires a very, very large margin of safety. So let's get into the weeds on these challenges. First off, the returns on capital. They're mediocre at best, and honestly, they're often heading downhill. Any kind of protective economic moat these companies once had is either shrinking fast or just gone. Plus, their future can be turned upside down by a single decision from regulators. And get this, they have to spend boatloads of money on their networks just to tread water, let alone get ahead. All while, new competitors are constantly jumping into the fray. You know, to really get why things are so nuts today, we've got to rewind the clock a bit. The incredibly competitive world we see now is a direct result of the government forcing the breakup of one single, totally dominant company that used to control everything. See, for generations, it was simple. There was just Mabel. AT&T was a true monopoly, owning pretty much all of the local and long-distance networks. Its stock was considered the ultimate safe bet. You paid your phone bill, they printed money. It was that simple, that stable. So how did this whole fortress of stability come crashing down? Well, it was really a 1-2 punch. First, in 1984, the government broke up the monopoly. AT&T had to spin off its local networks into 7 baby bells and was left with only the long-distance business. Then, the knockout blow came in 1996. The Telecom Act forced those very same bells to lease their own networks to competitors. These two events completely dismantled the old system and unleashed decades of brutal competition. And all that history? It leads us directly to the modern landscape, a fragmented, chaotic, and intensely competitive environment where it feels like everyone is fighting tooth and nail for the exact same customers. Okay, this table really breaks down the main battlegrounds. You've got the regional bells, who still have some control over local lines, but that advantage is shrinking fast. The long-distance business, it's a total bloodbath with zero pricing power. And wireless, well, that is the definition of a commodity service, with all the major carriers just locked in these brutal price wars. The only real bright spot is the rural carriers, who operate where there's less competition and often get a boost from government subsidies. And if you want a number that really drives home just how fierce this wireless competition is, here it is, 95%. That's how much of the US population has a choice of 3 or more wireless carriers. In a lot of places, it's 5 or more. When you, the customer, have that much choice, well, that puts a ton of pressure on these companies. And what happens with all that pressure? You guessed it, price wars. When it's tough to tell one company's service from another, the only real weapon left in the arsenal is price. And the result? The average price per minute for wireless service has cratered by over 80% in the last 10 years. That's amazing for us as consumers, of course, but it's an absolute nightmare for company profit margins. So yeah, with an environment this brutal, it is so easy for an investor to step on a financial landmine. So let's walk through some of the most common traps you really need to watch out for.
Okay, pitfall number 1, getting fooled by revenues that look great today but are gone tomorrow. The classic case study here is Quest. Back in the day, they were reporting this incredible growth. But it turned out a lot of it was from selling off network capacity and booking all that revenue at once. It was a one-time sugar high. When that demand dried up, the revenue just vanished, and the company was stuck with a mountain of debt it couldn't pay.
All right, before we hit the next pitfall, we need to talk about a term you'll see thrown around all the time in this industry, EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. You can just think of it as a rough, back-of-the-napkin way to see how much cash a company's main business is generating. But here's the catch, and it's a big one. EBITDA can be a really blunt tool. It is not the same thing as actual cash flow, and if you rely on it alone, you can miss some really serious problems. For instance, a company could have rising EBITDA, but at the same time their accounts receivable are through the roof. That means customers aren't actually paying their bills. That's a huge red flag that EBITDA won't show you. And that, of course, brings us to the big one, debt. In a business that needs this much capital just to operate, debt is a constant danger. A really useful metric to watch is the debt to EBITDA ratio. Basically, it tells you how many years it would take for the company to pay back all its debt using the cash it generates. As a general rule of thumb, if that ratio is much higher than 3, you should be very, very cautious. I mean, look at AT&T's big push into cable. It's a perfect cautionary tale. The company borrowed massive amounts of money to buy up cable companies, thinking it was a great expansion. But they ended up with a crushing debt load and eventually had to sell those same assets for way less than they paid. It's a classic story of a risky, debt-fueled adventure gone wrong. All right. Enough with the doom and gloom, right? It's a tough industry, for sure, but it's not impossible to navigate. So let's flip the script and talk about what a strong, potentially successful telecom company actually looks like. And really, this is the single most important idea to take away. In an industry with so much uncertainty from regulators and technology, the companies that survive and even thrive are the ones with real financial strength. A rock-solid balance sheet gives a company the flexibility to weather storms and pounce on opportunities when their weaker rivals can't. So what does that financial strength actually look like? Well, it usually shows up in 3 key places. First, a strong balance sheet with debt that's well under control. Second, solid, predictable free cash flow. That's the real cash left over after all the bills and investments are paid. And third, healthy and consistent profit margins that show the company has some pricing power and runs a tight ship. And this comparison right here, it just drives home how much margins matter.
Remember we talked about those rural carriers? Because they have less competition, they've been able to keep their operating margins above 30%. Now compare that to the big regional bells who are stuck down around 20%. That 10-point difference is enormous, and it tells you so much about their underlying financial health. But what about a cool tech advantage? Doesn't that count for something? Well, yeah, for a little while, but it's rarely permanent. Nextel is the perfect example. Their Direct Connect walkie-talkie feature was this huge deal for years, but eventually, competitors caught up and rolled out their own versions, and that unique advantage just evaporated. Technology alone is almost never a sustainable moat. Okay, so let's tie this all together with a final checklist for any potential investor. First, because this industry is so unpredictable, always demand a wide margin of safety. Second, never forget that maintaining these networks requires an insane amount of capital. Third, because of those high fixed costs, profit margins are everything. Fourth, watch those debt levels like a hawk. And finally, always remember that at its core, wireless is a commodity business where price is king.
And that really leaves us with one final, big question to chew on. In an industry where technology, regulators, and new competitors can wipe out any advantage almost overnight, is the only truly durable competitive advantage a fortress-like balance sheet? It's definitely something to think about. Thanks for joining this explainer. If you're hunting for your next great investment idea, you could bury yourself in financial reports for hours. Or you could just open your pantry. Seriously, some of the most powerful long-term investments are hiding in plain sight, right there in your kitchen. Just think about it for a second. Brands like Tide or Oreo or Coca-Cola, these are staples in millions of homes. The companies behind them? Well, investors often call them defensive havens. And why is that? Because even when the economy gets a little shaky, people don't suddenly stop buying toothpaste or doing their laundry. That consistent demand creates a super reliable foundation for growth over the long haul. So, to really get a handle on this whole sector, we're going to break it down. We'll start with the giants in your shopping cart, then we'll look at their playbook for growth, and of course, the risks lurking on the shelf. After that, we'll get into their secret weapon, something called an economic moat, and we'll wrap it all up with a practical checklist for you, the investor. First up, let's talk about those giants. You know, the best way to think about this sector is to picture a giant tortoise. It's not fast, right? Growth here is often pretty slow, usually just chugging along with the overall economy. But that slow, steady, and deliberate pace is exactly what makes it so incredibly powerful and profitable over time. And the business model? It is beautifully simple. A company like Kimberly-Clark makes diapers and sells them to a retailer like Target. Smucker's makes jam and sells it to Kroger. That's it. They create products we all use every single day, and they have mastered the art of getting them onto the shelves where we shop. It's a classic, proven formula for just printing profits year after year. Okay, so if it's a slow growth world, how do these giants keep getting bigger? I mean, in a mature market that's already dominated by a few huge players, they can't just sit back and wait for the pie to grow. Nope. They have to rely on a very specific playbook of growth strategies. And that playbook really boils down to these 4 core moves you see right here. They can try to steal market share from their rivals, they can buy other companies, they can cut their own internal costs, or they can expand overseas. The most successful companies, they're usually doing a mix of all 4. Now, trying to steal market share, oh boy, is it expensive. Just get a load of this number from PepsiCo, almost $730 million. And that was just on research and development for new products over a 3-year span. That is before they spent a single penny on marketing. It is a super high-stakes game. And you know what? The vast majority of those new products are going to fail. All right, so growing by buying other companies, this is a real hit-or-miss strategy, and this slide shows you exactly why. On one side, you've got a home run, PepsiCo buying Quaker. It just worked. They had great synergies, same business, similar distribution channels. But on the other side, a cautionary tale. Gillette buying Duracell. They tried to jam their famous razor and blades model onto a totally different business, and it ended up being this huge, costly distraction. The third way to grow is to look inward, reduce those operating costs. Since sales growth is slow, a lot of companies focus on getting more efficient to squeeze out more profit. Colgate-Palmolive is a perfect example. Through a massive restructuring, they managed to boost their operating profit margin from 14% all the way up to a really healthy 20% in just 5 years. But, and this is a huge but, this strategy comes with a major risk.
A company that gets obsessed with cost-cutting can end up starving the parts of the business that actually drive future growth, like innovation and marketing. While Colgate was busy streamlining, its arch-rival Procter & Gamble was pouring money into its brands, and Colgate started to fall behind. It's a really delicate balancing act. And the final growth strategy is to go global. Because the US market is so mature, expanding overseas isn't just an option anymore, it's absolutely essential. I mean, just look at these numbers. A staggering 77% of Coca-Cola's operating profits come from outside the US. For Avon, it's 65%. This lets them take products that are literally a century old and introduce them to brand new markets that are hungry for growth. Of course, it is not all smooth sailing. Investing in this sector means you have to be aware of the very real challenges these companies are up against. So let's take a look at some of the risks you might find on the retail shelf. There are 4 big ones to keep on your radar. First, the incredible power of massive retailers like Walmart who can squeeze their suppliers on price. Second is litigation. That's a constant threat for certain industries, especially tobacco. Third, because so much money is made overseas, a strong US dollar can actually hurt their earnings pretty badly. And finally, valuation. Because these stocks are seen as safe, they can get really expensive as investors flock to them, particularly when the economy is weak. So with all those challenges, how do the absolute best companies not only survive, but thrive for decades and decades? The answer, my friends, lies in a powerful concept called an economic moat. This is the absolute key to their lasting success. So what is an economic moat? Well, to put it simply, it's a durable competitive advantage. Think of a medieval castle. The moat is that protective wall of water around it, shielding the castle's treasures from invaders. In business, it's what shields a company's profits from competitors. Companies with the widest moats are the ones that can just consistently earn high returns year in and year out. In the consumer goods world, these moats generally come in 3 main forms. First, economies of scale. Being so big, like an Anheuser-Busch, that you can make your product way cheaper than anyone else. Second, having incredibly powerful brands that create a real emotional connection with people. And third, having these exclusive distribution channels that are just about impossible for a new company to copy. This quote about Heinz ketchup is the perfect example of a brand moat. For years and years, Heinz built this ironclad reputation for quality. So the story goes, even when its competitor, Hunt's, finally made a ketchup that was just as good, it didn't matter. It was too late. The perception of Heinz's superiority was so locked into consumers' minds that the actual facts didn't matter anymore. Now that is a powerful moat. And if you want to see a masterclass in building a wide moat, just look at Wrigley. For over a century, they have completely dominated the gum market. You can see that right here in their nearly 60% market share. How did they do it? Well, they built it on these iconic legacy brands like Juicy Fruit and Spearmint, and then they defended that territory with constant innovation through modern brands like Orbit and Eclipse. That 1-2 punch keeps them miles ahead of the competition. All right, so we've covered the business model, the growth strategies, the risks, and the incredible power of moats. Now, let's pull it all together into one final, actionable checklist that you can use to spot the hallmarks of a truly great consumer goods company. Here it is, your checklist for a great investment in this space. First, look for dominant market share. Is this company number 1? Second, strong, consistent free cash flow. Do they reward their shareholders? Third, a real commitment to building their brand, not just constantly throwing stuff on sale. Fourth, a history of true innovation that actually changes the game. Fifth, efficient operations that don't kill future growth. And finally, and this one is so important, valuation discipline. Never, ever overpay, even for the best company in the world. And that really leaves us with a final thought. In a world that's always chasing the next big thing, these companies can seem, well, boring. But when you really consider their stability, their resilience, and those powerful economic moats, you have to ask yourself, could the most boring brands on the shelf actually be the most exciting investments for your future? All right, let's dive into what people call the old economy. We're not talking about the flashy tech stocks that get all the headlines. We're talking about the companies that make the actual stuff our world is built on. I mean, steel, chemicals, heavy machinery. This is the industrial materials sector. Now, it can be a really brutal, cyclical business, but if you're a smart investor, it holds some incredible opportunities. So today, we're going to build the playbook to help you find them. So let's kick things off with a little riddle. What could the fragrance in your soap, a giant caterpillar bulldozer, and a high-tech heat-seeking missile possibly have in common? I know, it sounds like the beginning of a really weird joke, right? But believe it or not, there's a serious and super important connection here.
And the answer is, they all come from the exact same place, the industrial materials sector. It's this huge and honestly often overlooked part of the economy that takes raw inputs, we're talking things like ore and oil, and transforms them into, well, everything. From specialty chemicals that create sense, to the heavy-duty steel for bulldozers, and even the advanced components for defense systems. This isn't just a sector, it's the physical backbone of our modern world. So, here's our playbook for today. First, we'll lay the foundation of the sector. Then, we'll talk about how to ride the wild economic cycle. We'll get into how the best companies build an economic moat, what success really looks like, and, just as important, how to spot the red flags. And we'll wrap it all up with a handy investor's checklist.
Okay, let's jump right into Chapter 1, the economy's foundation. See, to really get a handle on this sector, you have to understand that it's pretty much split into two very, very different camps.
On one side, you have your basic materials. Think of this as the hardcore commodity stuff: steel, aluminum, bulk chemicals. At the end of the day, a ton of steel from one company is pretty much identical to a ton from another. So the only weapon you have to compete with is price. It is a brutal, low-margin game. But then you have the value-added goods. Now this is where it gets a lot more interesting. Here we're talking about complex machinery, patented specialty chemicals, advanced aerospace parts. With these, companies can create a product that's genuinely better or different, and for that innovation, they get to charge a premium. Knowing which camp a company falls into is the first and maybe the most crucial step in analyzing it.
All right, on to Chapter 2, riding the economic cycle. And this is where things get, well, a little wild. Because if there's one single thing that defines this entire sector, it's volatility. And it all boils down to a phenomenon known as the bullwhip effect.
Just think about how a real bullwhip works, right? A tiny little flick of your wrist, it translates into a massive, cracking wave of energy at the very tip. Well, the economy works the exact same way. Let's say consumers get a little spooked and cut back on buying new cars by, maybe 5%. That's just the little flick of the wrist. But by the time that signal travels all the way up the supply chain to the folks making the steel and the aluminum, that tiny 5% dip has become a 30 or even 40% collapse in orders. That's the crack of the whip. And this chart right here, it's the perfect picture of that effect in action. The black line is the overall US economy, the GDP. Notice how it's a relatively gentle wave, right? It goes up, it dips a little, but it's not super dramatic. Now, look at that jagged gray line. That's the sales growth for International Paper, a classic cyclical company. That's not a wave. It looks more like an earthquake on a seismograph. When the economy has a good year, their sales just shoot through the roof. But when the economy cools off just a tiny bit, their business falls off a cliff. They are living at the very tip of that economic bullwhip, and man, it makes for a terrifying ride. So what makes these swings so violent for a company's profits? Well, it's a concept called operating leverage. See, to be in this business, you need huge, expensive factories and all kinds of machinery. Those are your fixed costs. You gotta pay for them whether you sell one single item or a million of them. Now, when the economy is booming and orders are just flying in, this is amazing. Your costs are covered and every extra sale is basically pure profit. You're printing money. But it's a brutal double-edged sword. When the economy turns south and your sales dry up, those massive fixed costs don't just disappear. They sit on your balance sheet like a giant anchor, dragging your profits down and in some cases, pulling the whole company under.
So, given all that, how does any company manage to survive, let alone thrive, in such a tough environment? Well, that brings us to Chapter 3, Building an Economic Moat. It is all about creating a powerful defense against all that chaos. The truly great industrial companies build this protective barrier around their business, what we call an economic moat, and they usually do it in one of four ways. The most powerful one, especially in commodity industries, is becoming the undisputed low-cost producer. If you can make steel cheaper than anybody else, you'll be the last one standing when things get tough. A second way is to have patented technology, like 3M with its adhesives or Gentex with its auto-dimming mirrors. Basically, you create something no one can legally copy. Third, you can create high customer switching costs. Think about a company like Pitney Bowes. Once their mail systems are baked into an office's workflow, switching is a huge pain. And finally, you can operate in a concentrated industry where you just don't have many real competitors, like the big defense contractors.
Let's look at a textbook case of that low-cost advantage in action. Nucor versus U.S. Steel. Nucor was a total disruptor. They built their business around newer, more flexible, and way more efficient electric arc furnaces, or mini-mills. Meanwhile, a legacy giant like U.S. Steel was stuck with these massive, capital-intensive, and really expensive to run blast furnaces. And the result? It's right there in the numbers. Nucor consistently pulls in a gross margin of almost 12%. U.S. Steel struggles to even hit 6.5%. And that difference, it isn't just a number on a spreadsheet. That's survival. That's the cash flow that lets Nucor invest and grow during downturns while its competitors are just trying to keep the lights on. Now that is a powerful moat.
Okay, so we know we're on the hunt for companies with a strong moat. But how do we actually spot them in the wild, just by looking at their financials? Well, that takes us to Chapter 4 and our analytical toolkit, the hallmarks of success. In a sector that's defined by these massive physical assets, the name of the game is efficiency. And our first tool for measuring that is called Total Asset Turnover, or TATO. The formula is simple. You just take the annual sales and divide by total assets. But what it tells you is really profound. It answers the question, for every single dollar this company has tied up in its factories, machinery, and inventory, how many dollars of sales does it actually generate? For these capital-heavy industrial companies, getting a ratio above 1.0, meaning you're generating more than $1 in sales for every dollar of assets, is a really strong sign of an efficient operation.
But, we can get even more specific. An even more powerful metric for this sector is fixed asset turnover, or FATO. What this does is it strips out things like cash and inventory, and it focuses only on the core productive assets, the property, the plants, and the equipment. This ratio is arguably more telling because it shows you exactly how good a company is at sweating its most important assets, the factories themselves. Is that billion-dollar plant a humming engine of productivity, or is it just an underused drag on the balance sheet? FATO gives you the answer.
Okay, fine. But does this obsession with asset turnover actually translate to returns for investors? Well, this slide makes the case better than I ever could. Up top, you've got United Technologies and General Dynamics. These are wide moat businesses. Now look at their FATO ratios, 6.2 and 7.7. I mean, they are incredibly efficient at using their assets. And their annual returns over a decade, 17% and a mind-blowing 31.5%. Now look at the bottom. Dow and DuPont, both no-mo companies with FATO ratios down around 2.0. Their returns, stuck in the single digits. The connection is it's undeniable. In the long run, the market rewards efficiency. The companies that squeeze the most out of their assets deliver the best returns, period.
So finding the winners is great, but it's just as important to know how to avoid the ones that can absolutely blow up your portfolio. And this brings us to Chapter 5, Spotting the Red Flags. And the biggest, brightest, flashing neon sign red flag in this entire sector is debt. I mean, just think about it. You have a business with wildly fluctuating sales because of the bullwhip effect, and you have high fixed costs. The absolute last thing you want to add to that volatile mix is a huge pile of debt with interest payments you have to make. A key metric to watch here is the debt-to-capital ratio. Once a company gets above 40%, you should be paying really close attention. If it starts creeping past 70%, that's when the alarm bell should be screaming. High debt is the gasoline that turns a simple cyclical downturn into a raging corporate bankruptcy.
This quote about International Harvester, it's just a chilling reminder of what happens when things go wrong. Back in the early 1980s, the farm economy hit a brutal recession. Both International Harvester and its big rival Deere were hit hard. But there was one critical difference. Deere had managed its balance sheet pretty conservatively, with debt peaking at about 53% of its capital. International Harvester, on the other hand, had been way more aggressive, letting its debt ratio swell to a staggering 86%. When that downturn came, Deere had the financial muscle to survive. International Harvester did not. It collapsed into one of the biggest bankruptcies in history. Same industry, same recession, different balance sheets, and tragically different outcomes.
So debt is the big one, but there are other pitfalls you got to watch out for. We need to keep an eye out for large, underfunded pension plans. For a lot of these older industrial giants, this is like a ticking time bomb on the balance sheet. Also, be really wary of value-destroying acquisitions. A classic case was Dow's merger with Union Carbide, a deal that was just plagued with problems and distracted the company for years. And finally, be careful of management teams that get obsessed with chasing market share over profitability. Sure, they might win the revenue race for a few quarters, but destroying your margins to get there is always a long-term losing strategy. All right, we have been through a lot. We've covered the cycles, the moats, the metrics, the red flags. So let's try to distill it all down into our final chapter, the investor's checklist. Here are the key takeaways to stick in your back pocket.
First, always remember this is an old-school, asset-heavy sector. Second, sales are going to be a roller coaster tied directly to the business cycle. Third, since real moats are pretty rare, your safest bet is almost always finding the undisputed low-cost producer. Fourth, efficiency is king, so get really comfortable looking at TTO and FTO. Fifth, the companies that win over the long haul are the ones that combine low costs with low debt. And finally, always watch out for those red flags: too much debt, shaky pension plans, and bad acquisitions.
So, if you remember nothing else from all this, please remember this one core idea. In the world of industrial materials, it all comes down to efficiency. It's not about who has the biggest factory or the most famous brand name. It's about which company can squeeze the absolute most revenue and profit out of every single dollar invested in its assets. Those are the operators that win, and those are the best long-term investments.
And that really leaves us with a final question to chew on. You know, we live in an investment world that is just obsessed with disruption, with software, with the next big intangible thing. It's so easy to dismiss these old economy companies as just boring. But now that you have the playbook, it kind of makes you wonder, right? While everyone else is out there chasing algorithms, where are the incredible, overlooked opportunities hiding in plain sight within the companies that still make all the tangible stuff that holds our world together?
Let's just jump right in. When you think about what powers our world, I mean, really powers it, from our cars to our homes, there's one thing you just can't deny: the absolute dominance of oil and gas. You know, we hear a lot about solar, wind, and nuclear, and they're definitely part of the story. But right now, they just can't compete with the sheer scale of hydrocarbons in our global energy diet. And just how dominant are we talking? Well, this number says it all. Roughly two-thirds. Two-thirds of the world's entire energy supply comes from oil and gas. Just let that sink in for a second. It shows you just how fundamental these resources are to, well, pretty much everything we do in modern life.
So here's how we're going to break it all down. First, we'll look at why oil and gas are really the engine of our world. Then, we're going to follow the incredible journey of a barrel of oil, from deep underground all the way to you. After that, we'll get into the really fascinating part: the power of price and who pulls the strings. And we'll wrap it all up with a handy checklist for spotting the winners in this massive industry.
Okay, so when I say oil and gas, your mind probably goes straight to filling up your car, right? And yeah, that's a huge part of it. But it's so much bigger than that. We're talking about heating our homes, and here's a surprise for many people: it's also about fueling a growing number of electric power plants. This is the bedrock of our modern energy system. So where does all this value actually start? It all begins way down, deep beneath our feet. The entire industry, all the trillions of dollars, is built on finding and pulling up hydrocarbons. And what are hydrocarbons? Basically, the compressed remains of ancient plants and animals. That's the first step, and you could argue it's the most important step in the entire chain. All right, so we've found the oil and gas. Now the real journey begins, getting it from the ground and into the pipeline. This leg of the trip covers two massive stages. First, actually getting the stuff out of the earth, and second, moving it where it needs to go for the next step of the process.
And that first stage, it has a name. It's called upstream. You'll hear this term all the time. It's basically everything to do with exploration and production, or E&P for short. This is the wild, high-stakes part of the business. You've got the giants like ExxonMobil and BP playing here, but also a ton of smaller companies that do nothing but search for and pump oil.
So after upstream, naturally, comes midstream. Once that crude oil is out of the ground, you've got to move it. Sometimes that means giant supertankers crossing oceans. But the real unsung hero of the midstream business is the pipeline. These are like the arteries of the energy world, crisscrossing continents, moving mind-boggling amounts of product. Now you really need to understand this, because this is what makes pipelines such a special kind of business. Unlike the boom and bust of finding oil, pipelines are often regulated, which means they produce this incredibly stable, predictable stream of cash. The best way to think about it is like a toll road. Once you build a pipeline from point A to point B, it's pretty much impossible for a competitor to build another one right beside it. That gives them this amazing, almost Moat-like advantage. So, we found the oil, we've pumped it, we've transported it. What's next? Well, now we get to the final stage of its physical journey, turning that raw black crude into products we actually use and getting them to us.
And this is what we call the downstream part of the industry. It's really two businesses in one. First, you have refining. These huge, complex facilities that crack crude oil into all its different parts, like gasoline, jet fuel, diesel, you name it.
And the second part is marketing. That's the gas station on the corner, the business of actually selling all those finished products.
But here's a super important point. Not all parts of this journey are created equal when it comes to profits. Refining is usually a much tougher, lower profit business than exploration is. And the reason why is fascinating. There's no big, powerful cartel out there trying to keep gasoline prices artificially high for refiners. But, as we're about to see, there is one for crude oil, and that changes everything.
Okay, we've walked through the physical journey of a barrel of oil. But to really get this industry, you have to look past the pipes and the pumps. You have to understand the invisible forces, the financial and geopolitical powers that truly run the show. And it all boils down to one thing: the power of price.
This quote really just says it all, doesn't it? At the end of the day, the single biggest thing that determines if an oil company is making a fortune or losing its shirt is the global price of crude oil. It's the tide that lifts or sinks every single ship in this sector.
And this chart, wow, it just perfectly illustrates that point. Let's take a quick look. See on the left, that's the price of crude oil, going from super low, like $5 a barrel, up to $55. And the bars show you who's making money at each price point: the exploration guys, the pipeline operators, and the refiners. And what you see immediately is how the whole story changes for each of them depending on that one number.
So let's just nail down what that chart was showing us. You've got the upstream companies, the explorers, on one side. Their profits are a total roller coaster, completely at the mercy of the oil price. Then you have the midstream pipelines on the other side. Look at how stable their profits are. They're almost immune to what the price of crude is doing. It's a perfect picture of the different kinds of businesses living under one industry roof.
So, if the price is so important, who controls it? Well, a huge piece of that puzzle is OPEC. You've probably heard the name. It's the Organization of Petroleum Exporting Countries. But really, what is it? It's a cartel. Its whole goal is to manage the oil market for its members' benefit. And how do they do that? By agreeing to limit how much oil they produce, which keeps supply tight and prices higher than they would be otherwise. And you cannot overstate how important this is. OPEC's existence has been an incredible gift to oil producers everywhere. By essentially putting a floor under the price of oil, they make sure there's almost always a healthy gap between what it costs to get oil out of the ground and what companies can sell it for. That gap, that's profit. And that's been the magic formula for decades. But here's the twist. Not everybody in the oil patch benefits from this. The oil producers themselves, they're the ones who directly benefit from OPEC keeping prices high. But then you have the oil services firms, companies like Halliburton and Schlumberger that producers hire to do the drilling and the dirty work. It's a cutthroat, competitive business, and they don't get that OPEC price protection. The result? They've often had a much tougher time creating long-term value.
Okay, so we've covered the journey of the barrel and the almighty power of price. So let's get practical. How can you tell the winners from the losers in this complex industry? What should you actually be looking for?
Here are 4 big things. 1. Strong financials. The best companies can still make money even when oil prices crash. 2. A clean balance sheet. Low debt is absolutely key to surviving the bad times. 3. This is a big one. A reserve replacement ratio above 1. It just means they're finding more oil than they're pumping. They're not slowly going out of business. And 4, they're shareholder friendly. They return their profits to owners through dividends or by buying back stock.
Now, of course, no investment is without risk, and this industry has some big ones. The number one threat? If OPEC ever fell apart or lost its influence. Or what if a country like Russia just opened the tabs and flooded the market? Then you've got the constant threat of political chaos in oil-producing regions. And of course, the big one, the long-term risk of a new technology that completely changes our reliance on oil.
But here's the thing you have to remember. Those risks, they're not new. Not at all. The industry has been staring down these exact same threats for decades. And through it all, it has managed to navigate those challenges and create just staggering amounts of wealth for investors.
And this quote really brings it all home. For more than 100 years, energy stocks have, on the whole, been fantastic investments. Why? Because of that powerful combination of relentless global demand and an industry structure that helps protect profits. And the bet is that this environment is likely to stick around.
Which leaves us with a million-dollar question, doesn't it? We've seen how this industry built an empire of wealth over the last century. But looking ahead, in a world that's wrestling with price swings, political minefields, and the race for new energy, what does the next century hold for this global giant?
You know, for decades, there was this one corner of the stock market that was seen as the ultimate safe harbor for investors. We're talking about utilities, of course, but the ground has completely shifted beneath this once solid sector. So today, we're going to dive into this new reality and totally rethink what it means to invest in these companies.
So this was the classic picture, right? Rock solid, predictable, and a super reliable source of income. It was the kind of investment you could just buy, tuck away, and not lose a single wink of sleep over. It was simple, it was dependable, and for a very, very long time, it was absolutely true. But guess what? That time is over. The entire playbook has been torn up and thrown out. What used to be a sleepy, predictable industry has become something way more complex and, let's be honest, a whole lot riskier. The idea of utilities as some kind of foolproof investment, that's now a dangerously outdated myth.
So how in the world did we get here? Well, here's our roadmap for this explainer. First, we'll talk about the big shift away from safety, then we'll look at the catalyst that really changed everything. After that, we're going to dissect a modern utility company, figure out who really holds the power, and finally build a brand new playbook for investing. And we'll wrap it up with an essential checklist for you.
Okay, so here's the fundamental shift. Many utility companies have gone from being these cozy, regulated monopolies with basically guaranteed returns to competing in a really volatile commodity market. They're now selling a pure commodity. We're talking electricity here, in an environment with huge fixed costs and more competition. This one shift completely changes the entire game for investors.
So what was the turning point? You know, this wasn't some slow, gradual change. Nope. It was more like a seismic event, triggered by a fundamental change in the law that kicked off this whole new age of deregulation.
So think about it. Before 1992, your typical utility was this huge, integrated giant. They made the power, they sent it down the big lines, and they delivered it right to your house, all under one regulated roof. But then 1992 happened, and a new federal law just blew that whole model to pieces. It forced utilities to separate their power plants, their generation assets, from everything else. This was the real start of deregulation, and it cracked the door open for competition where there was none before, letting states write their own free market rules.
Okay, so to really get your head around this new world, you have to understand that a modern electric utility isn't really one business anymore. It's basically three separate businesses rolled into one, and each one has its own economics and its own risk profile. Let's break them down.
All right, first up, generation. These are the power plants. Now this is where things get wild. Because electricity is a pure commodity, this part of the business is hyper-competitive. The barriers to getting in are falling, independent producers are flooding the market, and in a lot of states, you can even choose who generates your power. Trying to make a consistent profit here? Man, it is tough. Okay, next we've got transmission. The best way to think about this is like the interstate highway system for electricity, those gigantic high-voltage lines you see stretching for miles. Building these things is insanely expensive, and hey, good luck getting permission to build one in someone's backyard. So the barriers to entry are massive, which creates a really wide economic moat. The catch? The rates they can charge are regulated, which puts a cap on their profits.
And last but not least, distribution. This is what we call the final mile, the local web of poles and wires that brings electricity right into your home or your office. This is a true natural monopoly. I mean, there's only one set of wires coming to your house, right? So that gives them the widest moat you can imagine. But, and this is a big but, because they are monopolies, they get the most intense government scrutiny. Regulators cap what they can charge and the returns they can make.
In this slide, wow, it just lays it all out perfectly. You can really see the huge contrast. Generation, high competition, narrow moat. Transmission, low competition, pretty wide moat, but regulated returns. And distribution, the widest moat of all, but again, returns are strictly capped. Understanding which of these games a utility is actually playing is absolutely critical.
Okay, if you remember just one thing from all of this, let it be this. In the world of utilities, regulation is everything. It's more important than the CEO, it's more important than the power plants, it is the single biggest factor that will shape a company's future. Period.
And we're not just talking about one single regulator either. Oh no, it's a whole multi-layered system. From an investor's point of view, the most powerful players are usually the state regulators. They're the ones who decide how much competition is allowed and, most importantly, the prices a utility can charge you. Then at the federal level, you've got FERC setting the big picture ground rules. And then you have operational regulators like the EPA, which controls pollution, and the NRC, which oversees nuclear plants.
Every single layer has enormous power.
All right, so with all this complexity, all this competition, and regulation, how on earth are you supposed to invest in these things? The old rules, they're not just useless anymore, they're downright dangerous. We need a new playbook.
This is a really big one. The way we think about debt has completely flipped. Back in the old monopoly days, taking on a ton of debt was actually a smart move to boost returns. Back then, lenders loved it. Why not? Cash flows were super predictable. But today, in a competitive world, that very same debt becomes a huge risk, a dangerous anchor that drains cash flow right when you need to be agile. And a lot of utilities are still weighed down by that legacy of high debt.
Look, I get it. A lot of people still look at utilities and think dividends, but you've got to ask yourself a really critical question. When you see a stock with a crazy high yield, is it a golden opportunity or is it a giant warning sign that the company's in trouble and that dividend is about to get slashed? So, here is your first giant red flag. The payout ratio, that just tells you what slice of a company's profits is being handed out as dividends. Now, once that number starts getting up over 90%, whoa. That means the company has practically zero wiggle room. Any little hiccup in the business could mean they have to cut that dividend.
And red flag number 2, it's all about the balance sheet. Check out the debt to total capital ratio. It basically measures how much of the company is propped up by debt. The average utility is already pretty high, around 60%. But if you see a company consistently hanging out above that 50 or 60% mark, it's another huge warning sign that the whole structure supporting that dividend might be built on shaky ground.
This right here, this slide just perfectly sums up the two different worlds you'll find. On one side, you've got your potentially more stable utility. It's likely operating in states with predictable regulation like you see in the Southeast. It's got a strong balance sheet, less debt, and it sticks to its knitting. And on the other side, a much more volatile beast. It's in a fiercely competitive market like the Northeast or California. It's probably weighed down by debt, and it might have a history of making risky bets in businesses it knows nothing about.
Okay, let's zoom out and pull this all together. The bottom line is this. What was once considered a risk-free corner of the market is now full of risk. And if you want to navigate it successfully, you have to know exactly what those risks are.
And the risks here, they are no joke. First and foremost is regulatory risk. The rules of the game can change on you just like that. Then you've got financial risk. All that debt across the sector creates a real problem if credit markets ever dry up. And finally, there's environmental risk. Let's face it, most power plants create pollution, so the threat of new, expensive cleanup rules is always lurking around the corner.
Yeah, there's just no two ways about it. The quiet, peaceful, stable era for utilities is ancient history. Today's companies are being forced to either sink or swim in some very competitive waters, and as an investor, you have to be incredibly selective.
So what's a takeaway? Here's your investor checklist for this new era. First, treat these things with a healthy dose of caution. Dig deep into those state-level regulations. It's complicated, I know, but you have to do it. Always remember that even the best monopoly has its profits capped. And watch out for high debt like it's the plague. If you're buying for that dividend, make absolutely sure it's safe. In the end, you're looking for that winning combo: stable regulation, a strong balance sheet, and a laser focus on the core business.
You know, this whole transformation of the utility sector, it really leaves us with a much bigger, more profound question. If the poster child for safe investments isn't really safe anymore, it forces all of us to reconsider what that word even means in today's market. What does a truly safe investment even look like now?